All right. So as I said, welcome to the North Dakota Soybean Council's Midseason Market Outlook Seminar. My name is Jenna Beertness. I'm Director of Market Development for the North Dakota Soybean Council. On behalf of the Council, we're pleased you've taken the time to join us today to discuss the 25-26 soybean marketing year. Today, you'll first hear from Dr. Frayne Olson, Professor for NDSU Agribusiness and Applied Economics, regarding fundamental and technical tools you can use going into this 2025 soybean marketing season. You'll then hear from Dr. Bill Wilson, Distinguished Professor for NDSU Agribusiness and Applied Economics, regarding the basis situation and his outlook for the 25 soybean market. And then we have Dave Spickler. He's new to the event. Dave will be joining us from Lighthouse Commodities, where he is a farm merchandiser, and he's going to provide an industry perspective coming into this marketing year. And then finally, we always have to acknowledge the weather. You're going to hear from Mark Ewens, meteorologist at KNOX, regarding a weather outlook for the rest of the growing season. Excuse me. For this webinar, we ask that you do keep your mic muted and video off unless we ask for clarification on a question you might ask. If you do have a question, please save it for when we take a break for questions. And if so, sometimes it's easiest if you use the chat function because then we can really refer to what you're asking. But if you would like to come off mute and ask, we can do that as well. If you're having any technical issues with the webinar, you can send a chat. There's a chat function. It should be a button at the bottom of your screen there. It says chat. You can use that if you have any technical issues, and we'll sure try to help you out with that. Otherwise, I'm going to turn it over to someone most of you know, Dr. Frayne Olson from NDSU. Frayne, if you are ready, let's get your slides queued up here.
All right, very good. Okay, share. Pull this up, put it on presentation. I need to get a couple things moved around so I can see what I'm doing. All right, very good. Is that looking okay, Jenna?
That looks good to me.
All right, fantastic. Well, good morning, everybody. Thanks for joining us. I have two sessions today. So first, we're going to go through the fundamentals, the supply-demand position, talk a lot about what are not only the traders seeing today, what are they anticipating coming up. I'll take a short break in between for some questions. And again, so please, if you be thinking about what questions you might have. So as I transition from the fundamental portion into the technical or charting analysis, we start talking about price movements a little bit. I want to have a break in there, not only to give people a breather mentally, because there's going to be a lot of material to cover, but also then to try and answer any questions you have. The other thing I will say that if you have some questions later on that you think about, that don't come to mind right away, I do have my cell phone number, my email. You please feel free to contact me if you wish, and we can have another discussion offline. So I'm going to be talking primarily about soybeans, but as most of you also know, the markets don't work independent of each other, and so I am going to talk a little bit about corn as well, because some of the pressures and influences happening in the corn market are spilling over and also putting pressure on soybeans. So let me get this working, and then we're going to start. So what are some of the key issues right now that the markets are watching, the market analysts and traders, from a supply demand or fundamental standpoint? We're going to spend some time talking about yields and yield expectations. This is the time of year where we normally spend a lot of effort and energy talking about yield and yield potential, simply because this August time period is not only important for soybean, for flowering and for pod set, but also for the corn with pollination and cob development. So weather conditions, I'm going to do, I only have two slides. I'll do my best Mark Ewan impression. I'm going to leave most of the weather analysis to the professionals, but I do want to point out there's a few things that the traders and analysts are looking at. I'm going to try and again give you the information that they're focusing on and how is that impacting their mentality or their viewpoints. We're going to spend a little bit of time talking about trade and trade negotiations. I'm not going to spend a lot of time on that because this is an ongoing development. There's a lot of pieces that are going on right now. In fact, there's typically, I had to check my comments and emails and data sources this morning just to find out what new is happening because it seems like it's changing every minute. There are both short-term implications and some longer-term implications, and I'm going to again try and confine my comments mainly to what's happening in the grain markets. A lot of in my opinion, and I'll talk about this towards the end of my session, this first session. In my opinion, that a lot of the short-term issues revolved around trade are going to impact you as farm managers more in your cost and the cost of production, in particular as we move into fall into next year, than necessarily directly on grain prices. And I'll explain my rationale for that in just a little bit. The other thing that we're watching, I'm not going to talk about it today simply because it is an evolving story. There's also some longer term issues in renewable energy policy, and that's still evolving. We're not really going to focus on that today because we're going to have to make some shorter term marketing decisions. So let's go through the current supply and demand conditions. Again, I'm going to actually start out with corn, just to get that off the plate, because this is one of the things that is putting psychologically a lot of downward pressure on prices. So on Tuesday next week, August 12th, please circle that on your calendar. At 11 o'clock Central Time exactly, USDA will update the column in the far right-hand side in red. So those are the current forecasts for new crop corn. That's the corn crop they're growing in the field right now. In the column of blue, that's old crop corn. We're just about done with the old crop season. So the marketing year for corn and soybeans starts on September 1, which means it ends at the end of August. So the columns in blue are just about finalized. We have about, just a few weeks left in this blue column before we kind of close out all of the numbers. We won't get the official standing of the official ending stocks numbers, et cetera, until into September. But just realizing we are still focusing a little bit on some of the old crop issues. And then the column in the far left-hand side in green is from 2 years ago. We just use that primarily as reference points. So right now, previous to this, we were kind of having some debates and discussions about how many acres were actually planted. We're not finalized those numbers, but we have some more accurate information. The reason the WASDE report in August becomes so important is because we're going to update the yield and yield forecasts. Up until this point, USDA has been using trend line yield, and I'll show you that in just a moment and explain kind of what they do and why this August report is so important. So in August, the USDA methodology, the system that they use to come up with yield and yield forecasts, shifts and changes. So they move away from the trend line and they start looking at actual observations. And the two big observations or data points that they have beginning in August is first a farmer survey. So this is the first month that they actually ask farmers, what do you see on your farms and what is your expectation for yield? And then they're also doing some cross-validating or checking using satellite imagery. And I'll show you some of both of those just to give you a perspective on what not only USDA is seeing, but what other people are seeing. So the biggest piece of the puzzle is starting to get filled in August. Now in September, they add a third data point or third data source. So in September, yes, they resurvey farmers. They continue to update their satellite imagery and their yield forecasts based on NDVI and weather patterns. But they also go out and have field surveys. They actually send people out in the field and do sampling, random sampling across the U.S., just very similar to what a crop adjuster would do. Okay, so August we got 2 data points. September we have 3 data points, and they're blended together. It's not a simple average, but they are blended together. Now, right now the expectation is that this trend line yield of 181 is too low. I've only seen so far, I haven't been able to find a long list of industry expectations yet. There are 2 companies that have come out with their individual forecast for both corn and soybean yields. And the first one was StoneX. StoneX came out with their national average yield forecast of 188.1, 188.1. which is about 7 bushels higher than what USDA has. And S&P Global came out with a 186 number. So the mentality, the idea in the marketplace, and this has been going on now for several weeks, is that we're going to have a really big corn crop coming. This is going to look like an above average year. So let's look at the trend line. Let me explain this trend line and the number that we've been using so far. So the red line that bounces around is the national average yield based on USDA data. Okay, and when they close out the books at the end of the year, it actually happens in January, they do a very extensive process to try and get that national average yield as accurate as possible. They're cross-checking farmer numbers with the FSA data, with the RMA data. Okay, so they're combining all of that to come up with as accurate a yield number as they possibly can. It's still not perfect, but it's the best we got. Okay, so the blue line that runs through the middle of it is actually the trend line. So we're looking at it historically. What do we see as an average yield? So we're taking the average yield, we're adjusting for technology, better farming practices. The science of agriculture is getting better all the time. So the little dotted line on the far right-hand side in red, right at the very end here, that's 181. Now, USDA does earlier in the season adjust upwards or downwards just a little bit, that blue line, adjust that up or down a little bit, depending upon what they see for planting progress and early stage development. So my point, the 181 is what we've been using for a long time, and now all of a sudden we're getting these higher estimates. So the question we have for next Tuesday on August 12th is not whether the yield forecast is going to go up. The question is how much will it go up? Because right now the yield expectations, the mentality, the idea in the marketplace is we're going to have a really big, monstrous corn crop. So coming back to the supply and demand conditions, if we increase the production numbers, and we're already forecasting at that 15.7 billion bushels, we're already forecasting a record corn production. You add another 7 bushels, and now that's a little bit extreme in my opinion. I want to be very careful, this is my opinion. But if you take 7 bushels times 86.88 million acres harvested, that adds a lot of extra bushels onto our production numbers. Now, I don't anticipate USDA will increase it by that much, but we are looking at an increase. When they do that, they also rerun their forecasts for consumption numbers. So just because we're adding bushels onto this production doesn't mean that that automatically drops to the bottom line without any adjustments in consumption. Now, usually what I have seen, just as a quick rule of thumb, just as a really quick rule of thumb so you can get your mind wrapped around this, when production goes up or down, let's say it goes up by 100 million bushels. So we add 100 right here. What usually happens is the ending stocks go up by about 50. So it's about a 2 to 1 or about a 50% ratio. As they increase production, consumption prices go down, consumption goes up. So our ending stocks do increase, but not 1 to 1. It's about 0.5 to 1. Okay. So why are we talking about this? Why are these expectations about such a big crop coming? Again, every week USDA comes up with their crop condition ratings. These are individuals in each county that go out, either county agents or county FSA officials that go out. They call farmers, they drive around and look at the crops themselves. They try and get a feel of what is the crop conditions for each of the crops within their county. The county information is sent into the state and accumulated into a state number. The state numbers are then sent into the federal numbers, and it becomes the federal estimate. So we have information at the federal level, we have information state by state. As you probably know, a lot of the traders and analysts will look at what percentage of the crop is rated good to excellent. And if we look at the very top, this is the percentage, starting from when we started reporting in May, what percentage of the crop was rated good to excellent. And here's our 2025 number. This is as of August 3rd, so this is the most recent information we have at the beginning of this week. And you can compare how are we sitting today relative to last year's numbers versus the previous, well, basically previous 4 years. Okay, so if we think about 2024 as being an average year because our trend line yield and our actually reported yield was very, very similar within just a fraction of a bushel. What does that mean if we have this large increase in our condition ratings? And so if we think about specifically the dark green is the excellent, the light green is good, then we get the fair, poor, and very poor. So when we think about this distribution of saying, well, what is happening to the crop? Is the crop getting better in condition or is the crop getting worse in condition? And as you can see, that good to excellent rating, there's more and more of that going into the excellent category. And then the very bottom, it gives an idea of what the growth stage is. How are we staging it? And it looks as though we're ending nationally on average. We're getting towards the end of the silking period. There's some of the dough or the seed filling capacity is starting to occur now as well. So we're pretty much from a crop development standpoint, right on track with where we would expect to see. The crop isn't necessarily ahead of normal nor behind normal when it comes to crop development. Okay, so now let's look at NDVI. This is Vegetative Health Index, and this is the deviation or change from normal. Okay, so if you look at the scaling on the far right-hand side, if we took that look at these kind of pale green numbers, we're looking at about a 50% of normal. So we're about average. So think of these lighter green and kind of brownish colors almost as being normal. Well, this dark shows that it's well above normal. So when we look back historically and compare how green is the crop today relative to what we would normally see at this time of year, and in particular, if you focus on what we call the traditional corn belt, Iowa, Iowa, Illinois, Indiana, Ohio, we get into southern Minnesota, and now the western corn belt, which is Nebraska, South Dakota, and North Dakota. We look at this traditional corn belt, which is both corn and soybeans. Everything is looking very, very, very good. Again, this is a vegetative health. So this is, again, another visual inspection of what's happening. Not necessarily that all of this good, green, healthy crop is going to turn into bushels, but the expectation is that it will. Okay. Now, there's a lot of market analysts that do follow the drought monitor maps to say, well, what are crop conditions looking at? What do we expect to see? Now, again, this is really a measure of the amount of water in the soil, and it's looking at the entire soil profile. So when we get into these areas where it's red and maroon, what that really is saying is that the dry layer within the soil is getting very, very deep into the soil layer. So we're seeing wells going dry and irrigation systems starting to run out of water. It's these yellow areas that show that there's some crop stress. Now, if you notice, we do have some of that in North Dakota, this region in particular, right along the Canadian border, and there's been some pockets here in western North Dakota, right along the Montana border that have been on the dry side. They started the season early in pretty dry conditions. They have been picking up rain showers, so don't let me misunderstand anybody. Let me go back one. The crop is still looking very healthy right now. It's just the soil moisture conditions are below normal. Now, again, we're looking at the entire soil profile. One of the other things that USDA does track, and again, we're using satellite imagery. This is all based on rainfall patterns. My understanding is they do have some remote sensing on the ground to cross-validate and check this. Most of this, though, is composites from the satellite radar images that are going across. This is an estimate. I want to make sure everybody understands a computer estimate of the soil moisture. And again, this is soil moisture anomaly. What do we normally see at this time of year versus what we're picking up on the instrumentation now today? So if we look again at the scaling down here, those blues and dark blues are above normal rainfall or above normal soil moisture. Okay, now the question we have is that soil moisture saturated to a point where it's going to start drawing down and causing some yield drag? Or is this just we're very abundant soil moisture, and again, given the heat and the humidity we're going into, that the crop is going to need that? That's kind of a debate going on right now, but in most cases, people are looking at the soil moisture condition saying, look, this is just actually helping the corn crop and the soybean crop, both, to basically get through or weather this hot spell or this heat dome that people have been talking about. And I know Mark is going to talk a little bit about that as well as when that might change. So In general, everything that we're pointing to, if we look at the vegetative health, everything is looking very, very good. If we look at the drought monitor condition, in particular in the traditional corn belt for both corn and soybeans, but also into the western corn belt regions, we do have a few pockets of areas with some challenges, but in general, this is very, very good crop conditions. And again, we look at more surface moisture. This is measuring like the first meter or top 3 feet of soil. That's what they're trying to estimate. The root zone looks like it's got very adequate moisture conditions. This is my Mark Ewan impression. I'm not going to get too deep into this. I know he'll be talking about it in more detail. This is the 6 to 10 day forecast. Again, information that the grain traders and marketers are looking at. We do have some concerns about heat and temperatures. It has been very hot and humid in huge chunks of the country. I'm sure if you've been watching the weather at all, you recognize that. Again, some questions about what that might mean for yield and yield potential. But because of the good soil moisture conditions, I think most of the traders are viewing that saying, well, this soil moisture will help the crop be able to get through these hot temperatures. The rainfall looks like it will continue, in particular into the Ohio River Valley and parts of the eastern corn belt. So right now, there's really not a lot of worry. There's really not a lot of concern. Now, we still have growing condition left. And I'm gonna slip back in my slides here real quick, and I do want to show you this. Notice in 2024, at this time last year, we were looking at some very, very good conditions. And then as we saw moving into the harvest period, it started getting warmer and drier. And we did kind of take the top end off of that yield and yield potential. So I'm not saying that's going to happen this year. We do have some growing season left. But we're now at the point where for most of the country, that cob is starting to fill. And so as we get later on in the season, it's really a matter of what the test weight's going to be. All right, so let's keep going. Ending stocks. Again, this ending stocks number is an indication of the blue bars in the bottom, indication of how much corn I'm going to have left in the bin just before harvest. And of course, the larger the number, the more inventory we have coming into harvest, the lower the prices and more price stability we tend to get at. And so the question we have now coming into it is if these yield numbers that the private forecasters are coming out with are validated and confirmed by the USDA reports, our ending stocks will increase and could increase fairly significantly depending upon what those numbers are. Thus, the reason we've seen the downward pressure on corn prices. So let's shift into soybeans. Again, this idea, this perception, or this viewpoint that the crop is in fantastic condition, we really have no major concerns, is also spilling over into the soybean area. Okay, it's the same thing on the far right-hand side in red are the soybean supply and demand conditions. Now, as you notice, this yield, this total production number is not a new record. We're looking at some very strong yield expectations. But one of the things is we did reduce our planted acreage of soybeans this year. So we cut our soybean acres. We went from 83.6 to 87.1 last year and then back down to 83.4 this year. Okay, so we did cut back on some of our soybean acres, which is positive. But now again, we're looking at some pretty high yield expectations. Now, trend line yield is 52.5. StoneX, when they came out with their estimate a couple days ago, they put 53.6, so about 1.1 bushels per acre above what USDA was saying. S&P Global put on a 53.5, so a full bushel above. So again, the idea, the psychologically, the viewpoint of the traders, and in particular a lot of the buyers as well, is that, well, look, we're going to have this big crop. We're going to have lots of soybeans around. We're not really worried about what's happening. We should have adequate supplies. Just like in corn, I do want to remind everybody, if this production number goes up, USDA always does some kind of compensations as if supply goes up, prices start to fall, stimulating a little bit more demand, some recovery in demand. So there is not a one-to-one reduction or increase, in ending stocks. So just because production goes up doesn't mean that all of those bushels flow directly to the ending stocks numbers. So just be very cautious of that as you listen to to some analysts and people talking about what they think the ending stocks number will look like, because we will have some adjustment in the consumption numbers because of this dropping of prices. Now, if you also notice, because and this is the attitude going into the trade reports now coming out next week. Notice USDA originally was forecasting a decrease in ending stocks. The question I have is, if these yield numbers do come out in the data from USDA, we will likely have ending stocks numbers similar to or maybe larger than we did last year. Okay, so let's think again about the trend line. The red line that bounces around is the USDA number. Again, they have cross-checked that not only with farmer surveys, but with the FSA data and the RMA data, the crop insurance data, to try and come up with a final number that's as accurate as possible. Notice that the blue line is pretty much right exactly at the trend line. So this is the number we have been using up until this point. In August, we'll get more information using a new data source. So we are going to see some adjustments. The expectation is that that will be a larger number, thus the reason we've had some downward pressure on prices the last couple of weeks. How are we doing for crop condition ratings? Again, the same thing for soybeans, just like we had for corn. On the very top, what percentage of the crop is in the good plus excellent range? What percentage is that? You can see 2025 right here relative to what we saw this time last year was slightly higher. And when you look at, is the crop condition improving or getting worse, it looks as though the crop condition is improving slightly. So this portion that is listed as excellent versus good has been going up. When you look at crop development, and again, we're looking nationally now, not just up here in North Dakota, but we're going all the way from the Delta in Louisiana, all the way up into Missouri and the I states and up into the northern and western growing regions. We're just about done with all the blooming or flowering. We're starting to do some pod setting, so I know there's some initial pod counts that are going on. I'm trying to get some estimates of what yield might look like. The soybean crop at this stage is a little bit harder to get a really good estimate of what yield and yield potential might look like, just because of the biology of the soybean crop versus the biology of the corn plant. Okay, so again, I know I sound like a record here and repeating myself a lot, but people are very optimistic about what yield and yield potential is going to look like. So again, looking at the blue bars, just to give you an idea of what our ending stocks ratio is going to look like. Again, kind of visually, how large will the ending stocks be? How much grain are we going to have in inventory at the end of the year before next year? Again, that sets the tone for prices, not only the price levels, but also the price volatility. And so when we think about marketing and marketing plans, the price volatility part is going to be equally important, especially when you're trying to set some price expectations about what this might look like in the future. So right now, I do think, not only myself, but I know other traders and analysts are looking at this ending stocks number for both corn and soybeans increasing. If I were to kind of put a number out there, it would be something similar to what we've seen the last couple of years. Okay, so not that we're really building inventories. It's not that we're getting excessive inventories from what we've had in the past, but it's certainly not looking at reducing inventories just because of the expectation for high yields. So let's think about how we consume it. If we're going to have this really big production, if we're going to have all these bushels floating around, how do we use them up? I am going to go back to corn a little bit because, as I said, what happens in the corn market also spills over into the soybean market and vice versa. So there's this interconnection between the two. So we can't necessarily look at soybeans completely independent of what's happening in the corn market. So how do we use up corn? And to be very blunt, guys, I'm a little bit more worried about the corn and corn prices and trying to do a good job of marketing our corn crop than I am about soybeans. I think the soybeans, there will be some volatility. I think we're going to have some opportunities. They're not going to last very long, but I do think we'll have some little bit better opportunities on the soybean side. So where do we look at this? The blue line on top is feed and residuals. So this is the amount of corn, whole corn, been run through a combine that goes into a feed bunk. It could be beef, it could be pork, it could be poultry. a little bit of aquaculture. So what we're trying to do is count bushels. Now I do want to talk just a little bit about the residual number as well. So this is feed and residual. Residual is really those bushels that disappear on us. Either they're because of mathematical rounding error, or in Canada, when the Canadians do their supply and demand numbers, they call this spoilage and wastage. And often this feed and residual number becomes the kind of the catch-all for where do extra bushels go that we can't or have a difficult time counting. And typically, if we have a very large crop, that residual number also goes up. We have a little bit more spoilage and wastage simply because it's difficult to store a very, very large crop. And I do think grain storage, not only commercial grain storage at the local elevators, but also on-farm grain storage is going to be challenged this year. And not only up here in our region, but also in particular when we get into the Corn Belt. So I'm a little afraid of some outside storage, which usually leads to a higher spoilage and wastage numbers. So it would not surprise me at all that we see a little bit bigger numbers coming into the feed and residual consumption. Now, that doesn't necessarily mean that suddenly the size of the herd is increasing. Okay, and yes, we are, my opinion, start to rebuild the cattle herd as we get into this fall and into next year, but that's a very slow process. So in the next 12 months, it's going to be very hard to expand our livestock consumption fast enough to be able to compensate for all of the corn that we're going to be harvesting this next fall. On the ethanol side, in the red line, that looks relatively stable. Again, these little dots on the far right-hand side are the current USDA estimates. So we'll see what happens next week, what kind of adjustments are made. Again, from a policy standpoint, as well as from an economic standpoint, the ethanol plants are running pretty much at capacity. I'm not aware of any major expansion in the ethanol industry at this time, so I don't know that we're going to see a lot of new ethanol plants coming online in the next 12 months. So that's, even though the profit margins may look a little better for ethanol, it doesn't mean that we're necessarily going to consume a lot more corn. On the margin, there could be some, but again, I don't know that it's going to be enough to offset all of the extra production we're going to be dealing with. Which really leaves the third kind of component or third leg to our major consumption of corn, which is the exports. Now, currently, USDA is forecasting an exports number very similar to last year, which is a good number because last year's number was a record year. Okay, so the forecast for old crop corn exports is a record, which is good. Lower prices have been helping us with that, but is it going to be enough? So I'm going to go through that in a little bit more detail in a moment. Coming to soybeans, two bigger uses of soybeans, obviously crushing industry, which is the blue line, and then we have exports, which is the red. And as you can see, we've had a nice, really good, steady increase in crush demand, the amount of soybeans going into the crush sector domestically for several years. Some of that is because of the addition of plants like we have here in North Dakota. Some of it's because of a growth and expansion of existing plants that are increasing their capacity. So the plant itself is still in place, but over the last several years have been increasing crush capacity. So that's a positive, but it also takes considerable amount of time to put up a new facility. So just because we have a lot of soybeans this year does not necessarily mean that we're going to suddenly have a bunch of new plants coming online in the next 12 months. So if we have a big surge in supply, where are we going to be able to get rid of it? It will likely be in the export market. And as you can see in the red line, the export market has been a bit of a challenge for us for the last several years. And I just want to remind everybody from a timing standpoint, a reference standpoint, here's our 2018 and 2019 numbers. So this was the two marketing years we had during the China trade war #1. So 2 years ago, our soybean exports were almost identical in volume to what we saw during that trade war period. So we had a recovery very quickly, mainly because of the Phase 1 agreement, and I'll show you some numbers in a few minutes here. But because of increasing competition and increasing supplies from South America, Brazil specifically, we've seen our ability to compete in the global markets and be able to ship a lot of soybeans through our system has started to wane a bit. We did get a recovery, and we're seeing that now from old crop, so we're not quite done with this number here, but we're getting close. USDA is saying, well, we'll probably get something closer to what we saw before. Now, if we get the bigger production numbers, we see a downward pressure on prices. Are we going to be at a capacity or at a level where we're going to be competitive back in the global market? And I'll show you some numbers here in a few minutes. I think it's possible, but we're going to have to work at it. All right. So who buys our grain? So let's not only talk about the total volumes. So again, these export numbers here in total volumes. Let's look at it by country, and this is where the trade and trade agreements become important. For the last couple of years, I've been trying to use these tables just to give you a perspective on not only how much we sell, but who we sell to. So I'm going to explain this very quickly, and I'll show it both for corn and for soybeans. So the four columns on the left-hand side are 12-month totals, the full marketing year total for grain exports. Now this is in million metric tons. So if you notice this, the scaling up here, we went from bushels to tons, because that's how we typically track export levels. Okay, and so this 23-24 in this column right here is the 12-month total from the last marketing year. Okay, so that's from basically 2 years ago now. And the countries are ranked based on these numbers. The two columns on the far right-hand side are year to date. So again, we're focusing right now on old crop exports. And I'll talk a little bit about new crop exports or export sales in just a moment. So far for old crop corn sales, this is on the far right-hand side. This is how much we've sold under contract. Most of it's been delivered by country. Okay, and then right next to it is the previous year for the same time period. So the 23-24 total is right here. And then this is the year-to-date total that we have for that same time period. So we can compare how are we doing so far this year relative to last year and what was last year's totals. So just to comment here, just to point out, for corn, our number one customer for corn export sales is Mexico. And we've seen a pretty nice steady growth, in particular last year and coming into this year, some very good export sales into Mexico. By far our number one customer. Japan, a very good, steady, long-term customer for U.S. corn. Been relatively stable. We saw a little bit of an increase in 23. We've seen now another increase in 24. Then we get to Colombia, which again is a pretty good, stable buyer for us, at least the last couple of years. And then I want to highlight China. Now, again, I want to remind everybody this 2020-21 time frame, this column on the far left-hand side, is our our phase one agreement year. So this is the amount that we have sold to China in that phase one agreement. And the reason that this is highlighted down here is this is our previous record corn export year. And a large portion of that was because of what happened in China and Chinese purchases. What has happened since then? If you look over the last several years, we've seen a steady decline. And then we look at what we've sold so far this year. So for a reference point, one Panamax vessel, so a Panamax is the standard ocean-sized vessel that we send around the world to be able to deliver grain. That's kind of the normal. We usually figure about 60,000 metric ton is one Panamax. Okay, so a 60 on my graphic here is one vessel. And this is the amount of corn that we've sold so far to China this marketing year. That's for old crop corn. That's for old crop corn. The way that we've been able to increase our total export sales, again, if this number holds, this will be a new record for corn exports, is because of ROW, which is rest of world. So these are all the countries that I didn't have room to list on my list here. So our traditional customers are buying more. We've seen some increase in particular for South Korea, but look at this almost doubling of export sales into the rest of the world, meaning we're making sales into a lot of countries that are relatively, typically don't buy a lot of corn from us. Okay, so with lower prices, we have been able to move a lot more corn into the system. How about soybeans? Looking at the same table, the countries have changed a little bit, the order has changed a little bit, but it's the same principle. So this 2020-21 time frame, that was our phase one agreement. China did come in and buy more U.S. ag products, not quite as much as what they were had promised to do, but they came close. Okay. And what's happened to our export sales since then? And a lot of that has been a relatively steady decrease. This year, so far this year, this is old crop now, we have not sold as much as we did the previous year. Okay. And a large portion of that is because of the increased supplies coming from South America, in particular Brazil. The other thing that has happened is that the demand, the growth of demand, so the rate of growth for Chinese buying from the international market for soybeans specifically has been slowing. It's still growing, it's still increasing, but not as fast as it has in the past. I also want to point out who's our number two customer. Well, it's Mexico. Again, good, steady customer of U.S. soy. They have increased their purchases this year. Indonesia is down just a little bit. Japan is about the same. A lot of the other countries we're looking at are the same, and we do have this increase in the ROW, or rest of world. Now, the biggest challenge we have in soy, and I want to emphasize this too, just to get you to think about this, the growth of the soy export market is more complicated. Because if we're going to export whole soybeans, we need to sell it to a country that has crush capacity within country. Okay, because corn, you can offload the corn at port, you can put it into a train or a truck, and you don't have to process it at all to be used for animal feed. In the case of soybeans, if you're taking soybeans, you offload them at port, you need to run them really through a crushing plant before they become a viable feed source, or that you can use the oil from it. So it does limit our ability as the U.S. to be able to find additional export markets for whole soy. It's not impossible. I'm not saying we shouldn't make the efforts. We certainly should. But it's a more difficult process simply because we have to, again, look to those countries that have processing capacity. And one of the areas that people have been talking about more recently now is what's going on in Europe, the European Union. And I'll talk about that in trade agreements in just a minute. So Spain and Germany, as individual countries, have been pretty good buyers of our soybeans, especially over the last couple of years. Is there growth potential? Maybe. We'll have to wait to see. All right. The other thing, you've seen this graphic. If you listen to me talk before, this is our export sales are very seasonal. I know Bill is going to talk about this as well when he talks about basis and basis movements. We were really kind of hoping that towards the end of the season here, we might be able to increase some of our have a boost of sales towards the end of our old crop and coming into the new crop season. We've seen a little bit of that, but not to the degree I think a lot of people were hoping for. Again, a lot of that is because of the competing export pressure we have from Brazil. What about new crop sales? So again, the international buyers have to plan ahead. They need to be thinking 3 to 6 months forward in their ability to grow, to be able to purchase and procure and get delivery. So they do make purchases for delivery out of the new crop arena. So I only picked a selected selected countries I have for both corn. This is new crop sales for corn as of Monday. As of last Thursday. There was new data that came out this morning, but I just didn't have time to be able to update all of my slides. So this is already a week old. But notice our new crop sales for corn are pretty good. We've been able to book some sales getting ready for this new crop harvest. This is the same period last year, so we can compare last year's numbers at this time versus the current numbers. And notice that Mexico has also increased their purchases from this time last year, so they are buying ahead and being a little bit more aggressive at this time. Japan, also a bit more aggressive early on in the season. We'll have to see what happens later on. When we kick to soybeans, notice that our export sales to soybeans, the forward sales for for new crop export sales, similar to what we saw last year, but a little bit behind pace. Mexico again has increased. They're taking a little more coverage this year. We're seeing Japan come in a little bit more aggressively. I know these are not very large numbers because it's very early in the season, but we are starting to pick up some of those sales. Now let me comment just really quickly about ROW, or rest of world, and the majority of these numbers, especially for soybeans, are what's called unknown. So it's unknown destinations. So we have companies in the US have sold soybeans under contract, but whoever the company that they sold it to has not identified which country it's going to go to. So usually in the international trade world, when you see an unknown sale to unknown destinations, that's code word for China. Now, not all of that is of course, this unknown category, but a lot of those unknown destinations, especially for soybeans, do end up to be the Chinese. So notice that again, if we interpret it that way, the Chinese are a little bit behind in their forward purchases. And again, my opinion is a lot of that is just the carryover because of the large export sales and the large, exceptionally large crop that Brazil had this last growing season. So let's talk a little bit about that. I want to talk about total exports. So I'm going to go back to total exports by country. So the blue line is the amount of soybean exports from Brazil. The green line, which you should be somewhat familiar, is the U.S. soybean exports to all countries. And then we have the black line, which is Argentina, and the purple line, which is Paraguay. This dotted line is the current forecast for new crop soybeans. Now, notice what the red line is. That's the total imports, the total purchases that China has made from the international market. So that could be sourced from the United States, it could be sourced from Brazil, it could be sourced from Canada or Paraguay or Argentina. So my point is notice this nice steady growth in demand base from China, but also notice the growth of the ability of Brazil to be able to produce. Okay, and one of the questions that I often get is, well, could China completely cut us out of our soybean purchases? Do they have to buy soybeans from us? The short answer is mathematically probably not, but it would be exceptionally expensive. So I'm not saying that they want to do this, but the question often comes in, could they physically do it? Well, I do think physically they could do it, but again, it would be very, very expensive. The reason they come to the United States is, at least for a big portion of the year, we are the low-cost provider of soy into the global marketplace. So we have to keep that in mind as well. So what about current trade negotiations? I do want to make one or two comments here before I dive into the details of it. So a lot of the trade discussions that we have been talking about, or that you've heard in the news, are the import tariffs that the United States is placing on the purchases we make from other countries. So this is the inflow of product into the U.S. Okay. Now, in the past, one of the concerns we've had in agriculture is, so what happens to our exports? What happens to our ability to be able to sell U.S. grains and U.S. meat products into the global market? Are the countries we're dealing with going to retaliate? Now, as a general statement, so far the retaliation, the kind of the tit for tat that we saw the last trade war with China, has not occurred. That the countries that we usually buy a large amount of volume of products coming from other countries, those countries have rather said, well, let's sit down and see if we can negotiate some kind of an agreement, rather than getting into this big trade war, big fight over what's exactly happening. So fortunately, up until now, or up until recently, and we'll see what happens in the future, I don't know, but up until so far this year, there has not been a large amount of retaliation. So we've been able in the US, to continue to sell our products into other countries, at least from an ag standpoint. Now, the big question everybody talks about, especially in the soybean market, is what about China? Now, the calendar, the clock, if you will, for negotiating with China is different than the clock for negotiating with all of the other countries. And we do know that the negotiations with China are going to be much more complex, and so it's really on a different clock or a different calendar. Now, so far, the U.S. and Chinese trade officials have continued to meet. They have ongoing negotiations. There's some discussion that maybe President Xi of China and President Trump from the United States will actually get together either physically or by probably video call to be able to have some more face-to-face discussions. We have not had any confirmation of that yet. The 90-day basically truce, if you will, in a trade war with China, again, theoretically is going to end on August 12th. Now, there are rumblings, there are discussions, at least rumors floating around, that there will be another 90-day extension after that to allow more time for our trade officials to be able to come up with some kind of agreement or compromise. Well, that has not officially been announced yet, but it is something that there's a lot of rumors flying, and I think some of the trade people are anticipating that will happen. Now, what we're trying to do, and this is not just for China, but for a lot of the other countries, is negotiate what's called a framework agreement. So this isn't when President Trump says we got to deal with fill in the blank. What he's really talking about is we have an agreement on the framework. It's not that we have the actual formal trade agreement with all the I's dotted and T's crossed. That will come later. What they have is an agreement to say, well, this is the framework, this is what we've agreed to, and we're now going to have this kind of tariff or trade policy that at least in principle, this is what's going to happen until we get all the details worked out. Okay. So right now, for products coming in from China into the US, it's a 55% cumulative tariff. So that's adding up everything that we have done. That's a baseline 10% reciprocal tariff, a 20% for fentanyl trafficking, 25% pre-existing from President Trump's first term. So you add all those up, you get 55%. The Chinese have put an additional 10% on US ag products. I mean, US products, excuse me, on US products. So there is a tariff difference between soybeans from Brazil coming in versus soybeans from the United States coming in. And we have to recognize that. It's not a large amount, it's not insurmountable amount, but there is differences, okay? Now, there have been able to work out some exceptions for rare earth metals and for some magnets, which really impact our technology industry here in the US. Very quickly, Japan. We already have a bilateral agreement with Japan. Pieces of that were renegotiated. The base rate that the US has imposed on Chinese products coming into the United States is 15%. The Japanese have agreed to purchase an extra $8 billion of US goods. Now it's all US goods, but that does include both corn, soybeans, fertilizer, and some ethanol. Okay, so we might see the export numbers, US grains going into Japan, and that includes wheat as well, increase a little bit over the next several months. I'm crossing my fingers. Let's hope that happens. For South Korea, again, we have this framework agreement, very similar to the Japanese. It's a 15% tariff on Korean products coming into the United States, including automobiles. We're still negotiating some of the details. And again, a lot of this is not public, so it's very hard to get an idea of what the details look like. As soon as I learn something, I will certainly share that with you. For the Philippines, again, another really big customer for U.S. corn as well as U.S. wheat. It's a 19% import tariff, so products we buy from the Philippines. The challenge is when we get to some of these smaller countries is they're very reliant on selling U.S. Products that they manufacture into the U.S. market to generate the revenue they need to be able to buy U.S. ag products. And so, even though we may not, and that's some of this longer term issue that I'm concerned about, is even though there might not be an immediate price response in the grain markets, over time we might start to see some of these changes just because the revenue stream for some of these countries might get less. We'll have to wait to see. That's one of the concerns that I have longer term. Indonesia, again, a large potential market, in particular for some of the oilseed products like soybeans, a 19% tariff on all products. Mexico, my biggest concern, I'll be very blunt, my biggest concern is our trade with Mexico. In particular on the ag front, I know they're the number 2 soybean buyer, they're the number 1 corn buyer, they're the number 1 wheat buyer, so trade with Mexico is critical. Now, there's a 30% import tariff on non-USMCA products. Now, the USMCA covers a lot of products, and so on the margin, this 30% tariff is not, it's on other products, but it's not going to have, in my opinion, a very large impact just because the list of products is relatively small. Now, so far, again, Mexico has not retaliated against U.S. agriculture, which is really, really good. There was a concern at some point that they might do that. The current president, President Sheinbaum, seems to be getting along with President Trump pretty well. We haven't sensed any major change in their import stance for U.S. ag products. That's a good thing. Trade with Canada is much more tense. This is something that's much more challenging. The trade relationship between the United States, at least politically, between U.S. and Canada is much more tense. Again, this is 35% on non-USMCA products, with the exception of a 10% for crude oil and fertilizer, and then the 50% for steel, aluminum, and copper. So again, discussions are ongoing. My understanding is that President Trump and his trade team want to work on all of these other products before we get into the USMCA and trying to renegotiate some of the terms of the USMCA agreement. So that's on the docket. We'll have to make sure that we pay attention to that very closely. United Kingdom, again, this would be Britain. This would be Great Britain. We do have now a formal agreement with them. They are working on the details. This looks like it's going to be something that will be official and officially passed here shortly. It does allow some easier access for U.S. ethanol and for U.S. beef products. There's also some other ag products, again, that was not listed specifically what those ag products were. A lot of this, the discussions have been on automobiles, as well as intellectual property. Getting into the European Union, this again, the European Union is a little different than Great Britain. 15% tariff on all products. The beef, rice, ethanol, and sugar were not included in that. So there's still some tension between the European Union and the US on ag products. It's a little fuzzy from my standpoint exactly what has been agreed to and what has not been agreed to. I'm trying to dig into that a little bit more and get some more details. There is the potential we'd be able to try and provide more U.S. ag products into Europe, like soybeans, because they do have a relatively large crush sector, even though their crushing sector primarily focuses on rapeseed or canola oil instead of soybean oil. India, there was some potential. We had some, I think there were some people that were a little more optimistic that we might get a stronger agreement with India. India does have an appetite to buy more U.S. soybeans. That's one of the products that they are interested in buying. They're a little bit more self-sufficient in agricultural production versus China. They don't import nearly as much. So this is something that I am watching. Unfortunately, the political tensions between India and the United States have deteriorated. Agriculture is one of those big sticking points. You have to realize President Modi out of India, about 40% of the Indian population still lives on the farm and involved in production agriculture. So the last thing he wants to do is upset the farmers. And anything that deals with agriculture is a very politically sensitive topic in India. And so I think this will also take some time to be able to try and resolve. I got to be careful of my time. Okay, we're doing okay. We also have a lot of other countries on our list. Needless to say, some of these are not necessarily huge trading partners with the U.S., but I do want to remind everybody when we look at that ROW number, the rest of the world, it's some of these countries that are buying U.S. ag products and have the potential to buy some more, assuming that we can get the trade relations working. A couple final comments, and then I'll take a short break for questions. So be thinking about what your questions are. See, get my time right. When it comes to our price competitiveness, so I pulled these numbers from yesterday. This is the what we call the FOB bids, or this would be the value of U.S. soybeans loaded onto a vessel, ready to go to a destination. And I just wanted to compare right now the pricing for U.S. soybeans relative to Brazil and Argentina. Okay, so let's just look at this. So Brazil, this green line, this light green line right here, going from Brazilian soybeans in Santos, which is one of their major export terminals, loaded onto the vessel. This is where they are priced wise. And then we look at the United States Gulf, which is kind of this green color down here. Notice that we are now very price competitive. Now, this is just loaded onto a vessel, okay? This is, yeah, that's US Gulf. We still have to include transportation costs. So we still have to include the freight rates to be able to get it from the port into the final destination. So if we look at the US Gulf right here, again, the transportation distance between Brazil, Santos, and the US Gulf would be very similar. When we look at the US PNW, which is more of this brownish line, we see that the US PNW prices are a little bit higher. Okay. And again, part of that is the ability to, think of this as like a spot market. So this would be soybeans loaded onto a vessel ready to leave today. And the supplies available through the river system out of the traditional corn belt are better than they are in the northern plains right now. As we move forward in the future, this will be something we need to watch very closely. What happens now to the Brazilian prices as our new crop soybeans start to hit the market? What kind of adjustments will the Brazilians make, and in particular Brazil as well as Argentina? If you notice, the Argentina is more of this gold line. What kind of adjustments are they going to make to try and finish out their export season? Because again, both Brazil and Argentina had very large crops. And they're concerned a bit about their ability to store their extra soybeans over a long period of time. One more comment before I take a break here. I do want to show, because I get this question all the time. It's like, well, so how important is the value of the US dollar? And I want to, this is kind of a long conversation, but I do want to introduce it here. And I just physically want to show you the value of the US dollar that's quoted on the radio all the time. That's an index and it's a proxy. Okay, so we're looking at how does the US dollar compare against this basket of currencies of other countries. My challenge with using that as an indicator is that it's very heavily weighted towards the currencies in Europe. Okay, so, and it's a ratio. So either the US dollar could change or the European currencies could change, and that ratio will adjust. So I want to be very careful. Exchange rates matter. So the value of the US dollar versus the Mexican peso, the value of the US dollar versus the Canadian dollar, the value of the US dollar versus the Chinese yuan, that all makes a difference. But this index that we talk about on the radio a lot, this index is actually a very poor indicator of what trade and trade values look like. So this is soybeans. Notice that this is US dollars per ton. What I did was I converted the exact same graphic into Chinese yuan per ton. So the scaling changed. Instead of US dollars, this is a Chinese currency now. So I'm going to flip-flop back and forth. So I want you to look at, do these lines, the relative price differences between the US prices and the Brazilian prices and the Argentinian prices, do they really change in order? They start flip-flopping back around because of exchange rates. Well, you know what? They don't. So this is in US dollars. So if we look at on the far right-hand side, what happens to these rankings, the relative rankings? Do they look any difference in US dollars or Chinese yuan? Very small differences. I mean, it's almost imperceptible. Okay? Even if we go back in time, when we look at changes in the US dollar valuation, this index that I talk about, if we go back into, let's say, a May time frame, so let's look at the May in US dollars and then the May in Chinese yuan. Do you really see any difference other than scaling in the relative ranking? I mean, based on my eyeballs, I really don't see a difference. But if we look at the value of this dollar index from, let's say, February or March, the index was at 107 and now the index is at 97. Based on the index, that's a 10% decrease in the value of the US dollar. Well, that sounds like a big improvement, right? But my question is, so was that because the value of the US dollar decreased, or is it because the value of the European currencies increased? Because it could be either side of those. So what I'm really trying to say is, yes, this index is something we talk about. it influences psychology, it influences people's perception or ideas of what is happening in the marketplace. But if you really get down to brass tacks and you talk to the traders that are actually buying and selling our grains, you know what? That index is a very, very poor measure to use. So I get this question a lot. I wanted to address it today because I do think it's important that we don't spend too much time worrying about this index when it's such a poor measure of what really impacts international trade. Okay, so with that, I'm going to take a short pause. I know it took me a little bit longer than I anticipated to go through all of that, but there was a lot of material too. So I'm going to stop sharing for just a moment. Let me go, whoops. So let me stop sharing for just a moment and see if there's any questions.
If you do have questions for Frayne, you can put them in chat at the bottom of your screen, or if you'd rather say your question, you can come off of mute.
So while people are thinking, I'm going to make one or two comments about the short-term versus long-term impacts of the trade and trade relations. And these are just my observations, guys. And so I'm not clairvoyant. I don't have any special information. I can't forecast the future. But just as a somebody sitting back and thinking about what this all means, as I said earlier, right now the grain markets, corn, soybeans, wheat, they're not ignoring what's happening in the trade world. They're watching it very, very closely, but they realize that at least short term, it's not having a direct impact on our ability to sell grain into the international market, which is a good thing. I am concerned longer term about longer term trade relations. That some of the countries that we're dealing with, number one, they need to sell some of their, especially some of the smaller countries, need to sell some of their products into the US market to generate the revenue they need to be able to turn around and buy US ag products, number one. Number two, in my opinion, the U.S. agriculture, in particular some of the commodity groups like the Soybean Council as well as others, are really going to have to buckle down and put an extra effort into maintaining open discussions and open conversations about what's happening to make sure that the politics at the very high levels don't overwhelm our ability to be able to sell products into these different countries. As I've had a chance to visit with some international buyers, most of them understand that all the things that are being talked about are beyond our control as individual farmers or individual merchandising companies. That this is at a very high political level, and we don't always have the say or influence over what goes on as we'd like. So both the exporters in the form of US companies as well as the importers are trying to figure this out and say, well, how can we manage around this? How can we try and maintain these good relationships? And hopefully, my issue is we're going to have to work a lot harder at that. We're going to have a lot better open communication about what is happening, why it's happening, and what we can do to try and figure out how best to maintain this trade flows. I am a bit concerned also that probably a more direct impact on US agriculture is going to be our cost of production. I am concerned about not only input costs like fertilizer and chemistry, but also some of our overheads like machinery, any kind of buildings or new construction. Steel and aluminum as well as copper prices are going to go up. A 50% import tariff on all steel aluminum coming into the US is going to have an impact. It's something that won't have necessarily something you're going to see tomorrow. But if you start making bids for construction or a new machinery, I think we're going to start to see that adding up pretty quickly here. So I am a little bit concerned about inflation, if you will, in our cost of production.
Frayne, I was going to point out we do have one question in the chat.
Okay, very good.
If you want to, it says,
Okay.
we're looking for a forecast for domestic crush now that we've seen the new RVOs coming out of the EPA. Do you think that will change domestic crush numbers? And for those who don't know, RVOs are renewable volume obligations.
Right.
Frain, you're probably going to get into that, but we use a lot of acronyms, so I will
Yeah.
spell those
Well,
out.
to be honest, I was kind of hoping I could avoid all of that discussion, but no. So let's dive into it. And I got it gets fairly complicated fairly quickly, so I'm going to try and stay at a relatively high level. I do think it will help crush margins, and in particular stabilize vegetable oil prices because there's two parts to this. Part of it is the RVO, which is kind of that required blending limit. We can exceed the blending limit, but we do have to maintain that blending limit. And the fact that that got increased and will increase over time is a very positive thing for demand for domestic oil seeds. The other part of this tariff discussion, and actually part of the renewable fuels issues, was that the RINs, renewable identification numbers. So every time that, for example, ethanol or biodiesel is blended, whenever you blend that, there's a blending number generated. And for those companies that can't blend enough, they can go in and purchase these RINs or these blending certificates, if you will, from someone else that has blended more than they anticipated. Now, the reason that's important is because the the that blending credit, that RIN that's generated, it's a smaller generation for oil seeds that have been purchased internationally, either oil, vegetable oil, or vegetable oil seeds. So if we're buying, for example, canola oil from Canada and bringing it into the US, that's not a one for one RIN. So if we take a gallon we blend a gallon of biodiesel and we use vegetable oil that's been imported, that is a zero point 0.5 RIN, not a 1.0 RIN, meaning that now there's more of an incentive for domestic blenders, the big oil companies, to use domestic oil supplies to meet the RVOs. So there's two things that happened. First, the amount went up for this blending requirement, but also the credit that you get and your ability to re-merchandise some of these RINs has also changed. So they differentiated vegetable oil that's produced domestically versus vegetable oil produced internationally and imported. And that will also help support the domestic crush industry, in particular in the form of higher vegetable oil prices. Now, the one thing with renewable diesel versus biodiesel. So biodiesel is where we're taking vegetable oil and blending it with diesel fuel, versus renewable diesel, where we're taking the vegetable oil, refining it, and actually making diesel fuel. Those are slightly different. The RVOs are slightly different on those. The demand for vegetable oil is very, very different. Okay, so I do want to, this is where it gets really complicated. The final statement I will say is yes, short term, these are very positive. These will help support prices and domestic blending. Longer term, we also need to maintain incentives to try and grow the industry, in particular for the renewable diesel, where we're manufacturing diesel from vegetable oil or vegetable oil products. That was part of the tax plan, and I'm not as well versed in the 45Z discussions. Actually, Dr. Dave Ripplinger, who is my colleague, he's very on top of that, and he and I have not had a chance to talk about what the final version of the one big beautiful bill and what all the 45Z requirements are in that. So I haven't had a chance to study it, but that would hopefully again be supportive longer term to encourage more investment and more infrastructure development for renewable fuels. Kind of a long-winded answer to a very good but complicated question.
Sure. Thanks, Frain. If you want to jump into your next
All
portion,
right, I will do that. Yep,
that's great.
let me share screen again. Okay, share. Let me stop this, minimize that. I need to pull up this. So just very quickly, we're going to go through a little bit of overview of some of the technical analysis. This is a shot of, let me hide some stuff so I can see what I'm doing as well. This is DTN Profit X. This is one of the information sources we have at NDSU that we use within our commodity trading room. Soybean trade is up here in this kind of top central region. We have the different contract months. The little blinking and flashing that you see is live trade. What I've done is highlighted the November 25. So this is November contract. Most of the elevators in the region have switched to trading off of the November contract and pricing off the November contract, simply because that's the most active. And if they were to buy, I know there isn't a lot of old crop soybeans left in the bin in this region, but if you were to buy some old crop soybeans right now, realistically, they're not going to be able to be delivered and find a really good outlet market internationally, in particular, if you're a local elevator, until later on. It's going to be priced off of the November contract. Now, some of the local crushing plants, I believe if I haven't checked recently, but I believe they're also pricing off in November simply because the elevators are doing it as well. So I'm gonna kind of review or talk about what is from a technical standpoint, from an analyst standpoint, what do we see as signals in the marketplace? So let me pull up a couple slides here. First is going to be the kind of simple support and resistance levels. There's different ways to be able to analyze pricing and price movements. So the fundamental supply and demand is what I talked about just briefly before. This is really kind of setting that expectations for the future and some of the things that we're watching. This is actually looking a bit more short term in nature, a bit more focused. And what we're doing in technical analysis is looking for pricing patterns. Based on price movements, can we give some ideas or suggestions on direction, about momentum, and when that momentum might shift or change? And one of the simplest and most straightforward ways of doing this is using support and resistance lines. These are the blue lines that I've drawn in. So the black line is daily trade. So the height of those bars represent the trading range for a particular date. If you notice, this goes all the way back to May 2024. So what I've done, and this is kind of the simple techniques that we use, we start in today's kind of where we are today, and we start looking back in time, and we're looking for these key turning points. So when prices are falling, at what point do they stop falling and recover and move back upwards? And if prices are in an upwards movement, at what point do they stop and turn the other direction? So we're looking at these as key psychological barriers, kind of mental barriers. If we start seeing prices increasing, how high will they go before we start running into some psychological resistance? Or then if prices are falling, how low will they go before we see that psychological floor hit? One more thing, just to remind everybody, and again, we're looking at a little bit shorter planning horizons here. We're looking at indicators of shorter price movements, and it does help us put this framework in place. So let me rephrase this. If we're in a downward price movement like we are right now, what we tend to see as prices start to fall, we start to see more buying and less selling. So at what price point do the number of buyers start outweighing the number of sellers? So this is all about the volume and quantities being purchased and the volumes and quantities being sold. So if you also notice, now this isn't a hard rule, there's no laws that say this has to happen, but when we look at support and resistance levels, we tend to see these break points at something very close to ending in a 0 or ending in a 5. And the reason is those are psychological points. If I were to ask you, at what pricing point would you be willing to sell more soybeans? I forced you to put a number down on a piece of paper. It would likely end in a 0 or a 5. And we tend to see that in these key pricing points. So 1104, looking at 1074. Now the 1043 is kind of halfway in between. I get that. And here's a 1013. But we start seeing some numbers that are very close to these evens. Okay, 971, 961. So at this point, we've got obviously some downward pressure on November soybeans. And I've already explained a big portion of that is this psychological belief or this perceived belief that we're going to have this very, very large soybean crop. We know that the Brazilians had a good crop. We know that the Argentinians had a good crop. We know there's adequate supplies in the marketplace. Now it looks like the U.S. is also going to have a very, very big crop. So what does that mean for not only the value of U.S. soybeans, but also the soybeans internationally? And if you do notice this black box right here, this is live trade, so you will see that jumping up and down a little bit as I'm talking. So where are those psychological points? We've really been kind of in some downward pressure. The question I often get is, so where will this stop? How low will it go before we put in some lows and things start to rebuild from here? Obviously, next week on the 12th, we will get more information, and I do expect the 12th to be a very volatile day. Whether it goes up or whether it goes down, I don't know, because I really don't know what the numbers are going to be. But if we think about downward pressure, in my view, there's two big psychological points. One would be obviously this 980 number. We didn't quite reach that a couple days or yesterday, but we did reach this 971 back in middle of March and a 961 back here in harvest of last year. So what we tend to see, this isn't a law, this isn't a rule, but we tend to see, especially in large crop years, prices starting to drift lower because of the expectation of big bushels. And that seasonal low often occurs, not always, but often occurs about halfway through harvest. And we kind of saw that last year as we move into this November, actually into the December time. We had some information that came out and it spiked and came back up again. So my point is, I do think there'll be continued downward pressure on soybeans, November soybeans coming into harvest now, unless there's some big surprise. What could those surprises be? The two most common surprises would be either weather or politics. And again, forecasting both of those is very, very difficult. I don't envy Mark Ewan's job at all, to be very honest with you. So this is one methodology that we use, support and resistance levels. Another one that's very common, let me pull up another chart here that I created earlier, is to look at what we call stochastics, which is movement. Now it's not only the direction that we're seeing, but how rapidly our price is changing. Okay, so what I'm going to do is zoom in here a little bit. I'm going to talk about three of them. And for anybody that's been through some of our training programs, these are the three that we tend to spend most time talking about to give a general idea of price momentum and price dynamics. At what point might we see that any downward pressure start to wane and we get a turning point in the marketplace? So the three that I'm going to talk about today, given the time that we have left, is number one, this Bollinger Bands, which is on the very top. Number two, the Relative Strength Index, or RSI. And then the third one is going to be the MACD, Moving Average Convergence and Divergence. And I'll explain very quickly what these three signals are telling us. And if all three of us are telling some similar signals, it usually means that that momentum is consistent, because we're measuring the same thing in three different ways. So let me explain this Bollinger Band very quickly. The red line in the middle is a 20-day moving average. So we're looking at it at about 1 month planning horizon. So when we look at these indicators, we're typically looking backwards about 1 month. 20 trading days would be 5 days a week times 4 weeks in a month is about 20 days of trading, which means that these indicators are probably pretty valid looking forward for about the same time period. So we're not looking at something 6 months into the future or 9 months into the future. It's saying, what do we expect to happen in the next month or so? Okay. So the red line in the middle is our moving average. Notice that the moving average is going lower and that today's prices are below the moving average. So that's an indicator that we're in a downward trend, not a surprise to anybody. The blue bars, those blue lines, excuse me, are plus and minus 2 standard deviations. So what we're saying is, given what we have seen historically, what would we say is the normal trading range for soybeans and soybean futures? So we know what the average is, But what's that normal trading range? And so we say plus or minus 2 standard deviations, which means about 95% of the time will be somewhere in that range. So if you think about this and saying, well, we've got below average prices and we're definitely on the low end of the historical range. So we're using history as our benchmark. We're saying, how do we sit today relative to history? So again, this is another indicator. Not only is our moving average going down, we're below the moving average of today's prices, and we're kind of on the low end of that normal range. So again, this is indicating that yes, we're in a downward trend. That's a fairly strong indicator that the downward trend will continue. Moving on to this RSI, Relative Strength Index. So what we're doing here is looking at the ratio, that relationship of the amount of downward price movement relative to the amount of upward price movement. And it's a ratio. So 50-50 means that, well, if we look back in time, we've had about 50% of the price movements have been upward, and about 50% of the price movements have been downward. So what this is an indicator of is, well, if we start moving to the downside, like we're at a 35, meaning about 35% of the time well, the downward movement has been much stronger than the upward movement. And what we're looking for is these key turning points. So if you look at it and think about it in a dynamic sense or a movement sense, it's very hard for a marketplace to have continued long-term down pressure without having some corrections. So it's not impossible, but it's difficult for this number to get below 30, to touch 30 or get below 30, or to get a touch 70 or get above 70. So what I usually use, some people use an 80-20 rule. I use a 70-30 rule. It's a lot of the same kind of concepts. So as we get closer to this 30 number, it means that we've had historically a lot of downward pressure. The question is there enough downward momentum to continue that moving lower? And if you notice on this one, I'll try and make it a little bit bigger here so you can see it. It looks as though that indicator is starting to turn flat. So we've had some very significant downward movement, but my indicator here, which is kind of a longer term momentum, if you will, it looks as though that downward pressure and that downward momentum may be waning a little bit, that curve is starting to flatten out a bit, which again, to me is a signal that we may be seeing some short-term lows. But again, something can happen tomorrow to change this. So I want to be cautious about this. So this is indicating, yes, we're having downward movement, but it looks as though that movement might be softening a bit, that we're not getting the downward pressure, that we may see a turning point in the near future. Okay, let me go to the last indicator, which is this moving average convergence divergence, or MACD. Okay, and I have about 5 minutes left, which would be about perfect. So what is this telling us? I just want to really look at these bars, the red bars. So think of those as the momentum indicators. So if it's below the 0 mark, it's saying that the movement if prices is downward, and the height or the size of that bar is indicating, is it a very strong movement downward? Are we seeing a rapid change downward? Or is the downward pressure starting to get less? And so notice that we've seen some downward prices. We saw a little bit of a recovery, and now we're seeing some more downward prices, okay? Well, again, confirming what the other indicators are saying to us. But look at the red bars. Those red bars are getting smaller, which means, yes, they're still moving lower, but that momentum is starting to slow. So the rate of downward movement is starting to wane, or it's starting to get less aggressive. So again, we're seeing that we have two indicators now, the MACD as well as this RSI, that yes, they're still going downward. We have downward pressure, but it doesn't look like that downward pressure is as aggressive as it was in before. So at least short term, we may see some stabilizing and at least some bottoming action occurring over the next several days. So coming into the report, that would make some sense, that traders are positioning themselves, they're getting themselves into a buy or sell mode where They're positioning themselves for that report that's going to come out next Tuesday. Okay, I got one more thing that I want to show you, and I'm coming back to the main. I get this question sometimes about how about the hedge funds? Okay, what are the money market guys doing? So this is a graphic. The black bars are the net long or short positions for our long the managed money, if you will. These are the fund traders. Okay, are they net long or net short? And we do see some correlations, some relationships between the red line, which is the futures market price, and then these black bars, which is the net position. So if we look at all the people that are long, all the people that are short, and again, we're focusing only on those hedge fund folks, only the money management folks, okay? And based on what we're seeing today, they're pretty much in a neutral position. So it's not like they're heavily short or that they're heavily long like we have seen over the last several months. So even some of the outside money speculators are saying, well, we're going to position ourselves kind of neutral. Okay, so it's not like we're going to see a whole bunch of hedge fund folks change their positions. It's not like they've taken a strong position one way or the other when it comes into this report numbers. So again, I just wanted to talk about that because I do get that question quite often. So with that, I will stop sharing. Let me get my escape button here. I will stop sharing because I have only a couple minutes left. I'm supposed to be in break at 9:35 and I'm at 9:32, which for me is like amazing because I'm normally about 10 minutes late.
This-
So again, with the last couple minutes, if there are any questions, I will try and do my best to answer those.
And just as we said before, if you have questions, you can type them in the chat, or you can come off mute if you'd rather articulate them. I don't see anything in the chat. I'm watching
All
to see
right.
if anyone's coming off mute. Don't think so.
Okay, well, I will be online here for the duration of the webinar, and I'd be happy to try and answer any questions if there's something comes up later.
It sounds great.
And so I'll hand things back over to Jenna.
Thanks, Rain. So with that, we are going to take a short break. We've had a lot of content here in the last hour and a half. Excuse me. So we will break until 9:40. At 9:40, we'll come back and have Dr. Bill Wilson talk to us about the basis situation and the outlook for our 2025 soybeans. So with that, let's break until 9:40. Right. From everybody back here. Bill, I see your slides.
Okay.
So everything looks good on my end. And so I'm just making sure we're all ready to go here. With that, I'm going to introduce Dr. Bill Wilson. He's going to talk to us today, as you can see from his slides, about the basis situation going into this harvest, and what he sees as things farmers should know in the next few months here. So with that, I'll hand it over to you, Bill.
Thank you, Jenna.
Yep.
So it's always hard to follow Frame because he covers things so thoroughly. And so I'm going to try to focus my comments strictly on the basis and the issues related to bases and spreads. Of course, I'll overlap some of Frame's conversation. My topics that I'm going to talk about is current market, uh, impact of shipping costs on spreads, and what that means from a market strategy perspective. I want to put to perspective for you. Frame used a crucial number is the stock use ratio. Frame used number about 7 in his slide. I list here on the right-hand side the stock use ratio for the last few years. I think the last estimate USDA was 7.6. A note I read last night from a pretty serious market analyst said the range is probably 7 to 9. That stock use ratio is the thing that has the biggest impact on what ultimately the futures prices will be. These are a couple of figures from SDSU that look at that. And what it really says is a stock use ratio of 7 to 9 probably means a futures price, an average futures price of 10 to 11. There's different graphs there. One of them kind of, you have to look pretty hard, but one of them kind of says maybe down to 950 to 11. We don't have a lot of precision about that within that range. I think Spickler's comments might give some more precision, but looking at a range of 950 to 11, that's what we should expect fundamentally in the underlying futures markets. One of the big things this year is the oil share is typically about 35% of the value of soybeans. Today it's 52%. That's reflective of the strong oil market, weak demand. These are the futures prices, as you're all aware, and these are last week. So now, as you all know, they've fallen since then. The major things impacting our bases, in my view, is the Brazilian crop, the size of the Brazilian crop and pace of exports, tariffs or the threat of tariffs, Chinese demand, and their efforts to diversify suppliers, the secondary rail market value and storage decisions, and I'll talk about each of these. Just as a refresher, this shows the growth in Brazilian production from 2010 until current. The most recent estimates for 25-26 is 174. That's a huge number compared to the previous 2 years at 155. That's an extra 20 million metric tons. That's the equivalent of 2 months worth of demand in China that they expanded their production by. The first projection already now for 26, 27 is at 184. So this Brazilian production is one of the most important factors here. And these are the exports. These are Jenna's exports. Frame showed a more updated piece, so I won't discuss more on that. But to discuss the significance of China, and I have a punchline at the end, is this. This is Chinese import demand for soybeans. The red line is the imports, and it's a very fast-growing market. People are trying to talk about it stabilizing out nowadays. Maybe, maybe not. The WASD or long-term USDA estimates have them, kind of continuing to increase over time, up to 140 million metric tons by 2030. So we'll see, but that's the driver to this market. This shows the pace of Chinese imports from all origins from 2015 until current. The brown line, which you see that spiked up in May, that was their purchases during the month of May. So you can see during the month of May, they are record high compared to all previous months, all previous years for that singular month. Last night, The Chinese released their numbers and Reuters interpreted them for the month of July, and their imports during July exceeded that value. So China's been importing record volumes the past few months, obviously in anticipation of a trade war. This shows the monthly pace of imports from 2012 until current. The purple line is Brazil, the red line is Canada, and the brown line is the United States. So again, you see that in the most recent months, it spiked up to a really high value, particularly from Brazil. This is how important China is to our market, particularly off the P&W. Again, these are Jenna's slides. But you can see without China, we got a huge problem on our hands because the next biggest buyers are pretty much pipsqueaks in this market. Okay, so here's a slide I'd like to elaborate on. This is from friends of mine who are international commodity brokers, McDonald Pells. And this shows the pace of Chinese imports by origin. And at the top part of the slide, it shows the purchases for 24-25, and the bottom part is 25-26. So you can see in the top part of the slide, they imported a total of 108 million metric tons, 23 million metric tons from the United States, 78 from Brazil, small amount 6 from Argentina. And from the United States, their purchases were really concentrated in OND, October, November, December. I have to tell you, I've been studying this a long time. Fran made a comment that we're the low-cost supplier for a large part of the year. You know, a few years ago, we were the lowest cost supplier for 6 months of the year, and then 4 months of the year. And these data suggest probably for 3 months of the year in 24-25. On the bottom part of the slide, it shows their import purchases. That means purchases plus shipments to date. And I circled in red the purchases they've made from the United States. It's 0. And so I just have to highlight that number. It's 0. And that's how serious the situation is with respect to China and the outlook for the bases, particularly off the Pacific Northwest. I can't elaborate how important that is. Never, since I've been teaching this and working in this, is at this time of the year, China had such a low amount of purchases from the United States as we start approaching harvest. Okay, I read lots of market reports every day. I just highlight a few, and these are my friend Jimmy at RJ O'Brien. I just highlight in yellow. Like a couple of days ago, they bought 9 cargoes from Brazil. Now we're approaching U.S. harvest. We're way beyond the end of harvest in Brazil, and they bought 9 cargoes for shipment in September, October, and October through March. So now they're buying already from Brazil for October. Data Agro, S&B company in Brazil, has them next year at 183 million metric tons. Now, you can show your own optimism about whether or not China's going to have a trade deal or not. Here's a quote from the Treasury Secretary, who's certainly calling the shots, and he said he would recommend Trump not to extend the China trade deal as currently specified. And then Jimmy says that new crop basis is under pressure in many regions in anticipation of large crops and potential lack of storage. That's going to be the storyline this year. Then a couple of days ago, we were advised that a non-Chinese company bought off the P&W, I think it was Taiwan, for October. That was the first transaction in many months for P&W soybeans. And that translates to a value back to the interior at minus 100 from a basis. Okay, one of the things that is going to hang over our head here, unless I'm missing something or something's changed, is Trump has a proposal to put a tax on non-U.S. vessels that take any commodities from the United States. These are expected to go, these were announced back in April. We've done studies on them and have presentations on them. But the bottom line is that the proposed tariff is $50 a ton. and they would be going into effect in late October 2025. I don't know if this has changed, but this is a really, really, really important number. And if China's not buying from the United States, this may be the reason why. $50 a ton would exceed the entire freight rate from Brazil to China. So that's a serious number. Okay, so we want to talk about spreads. We call them carrying charges in the futures. And typically people kind of blow these off as if they're not important. I have to tell you, we have more action in the spreads than we do in the underlying futures. So take a look here. So I use the word normal market and inverted market. On the left-hand side, this is a situation, we call it a normal market, where the successive months going forward have a positive spread to the nearby. On the right-hand side, we have an inverted market, where successive future months have a lower spread to the nearby. Ironically, yesterday I had coffee with a friend of mine who's a merchant at ADM and pretty high level, and she said, I started my career 5 years ago, and we've been in an inverted market every year for the last 5 years until now. Well, she's saying we're operating in the right-hand side, inverted market, with negative carrying charges, which means operate hand to mouth. And now we're entering a normal market for the first time in a number of years. So here are the numbers from a week ago, I guess, when I put this together. I know they've changed slightly since then. But I show the futures in the first column, and you can take a note there that going from August at 10:01 to May at 10:67, that's a big spread. That's a big, big number. That's cumulatively about 66 cents. If we use the 6-cent cost of storage, the net return to storage in those deferred months is 17 or 18 cents. Simply looking at that number, the best marketing strategy next year, sell futures and store. Store the commodity and sell futures. That's what it says. Now, the bottom chart shows on that date the change in the spreads from August of last year until current. So you can see they went from about 5 cents, to currently on this chart, 40 cents. And in the last day there, they increased just about 5 cents in one day. Now, I updated this just the other day because it's changing continually. In January this year, this is the May-November spread. In January, it was 5 cents. It's now at 50 cents. All this is doing is taking a big sledgehammer and pounding you on the toes, saying, store the commodity. Either farmers store it, processors store it, traders store it, or importers store it. But somehow it's got to create an incentive to store it. That's what the market's trying to induce here. We always study the returns to storage, and this is a calculation done by R.J. O'Brien, and he highlights here that the yield of storing after taking into account storage costs and all these types of things is 5.91%, which he says that it's near a commercial full carrying charge, which means that for a big company like ADM, Bunge, Cargill, this is approaching the point that they'll make all kinds of money if they store it. Simply buy the cash commodity, sell deferred futures. So when we talk about the basis, this is my representation of the markets, and I want to emphasize here, now we're talking about the basis, which is a spread between futures and cash. And this is impacted by rail markets and lots of other factors, which I'll speak to in just a moment. Okay, so here's my graph that I use in my teaching all the time. This is how we expect the basis to behave. And so the vertical axis is basis, the horizontal axis is time. During harvest period, we expect the basis to go up to abnormally low levels. And then they're going to stay there for a while until enough grain is put under storage. And then it will elevate and increase at an increasing rate. And then during the delivery month, the basis would be equal to the delivery charge, which in the case of Chicago would be about 2 cents. And so that's where we expect the basis to be during the delivery market. That black line is a theoretical line, which is the theoretical cost of storage. And all it says is we get closer to the delivery option month, the cost of storing forward lessens. So this is how we expect to behave. Now, you all know I've been teaching this a pretty long time, and we study this like crazy in this country because of all the crops we have in this part of the country, as well as in other countries. And this definition of what is the harvest period is kind of a nebulous concept because we're approaching harvest now in the next few weeks. So we're approaching the beginning of harvest, and it really doesn't finish until September, October. So the definition harvest period is not so clear. But it's very clear that just prior to or during harvest, the basis crashes. The reason for that is we have excessive farmer selling and not enough buying, and it's trying to provide an incentive for storers to initiate storage decisions. I believe that is what we're going through at this moment. So here's our bases in North Dakota as of a couple of days ago. You can see the predominant bases along the central corridor, about 60 under, 65 under in Castleton and Jamestown. Other parts of the state in the west, the base is a little bit lower. This is off of DTN, my DTN. We use it in our teaching here. So I'm going to show you a bunch of basis charts. I'm focusing only on the bases, but I show here, and this one is the bases of the PNW and the U.S. Gulf. The pink line is the U.S. Gulf. The blue line is the PNW. So you can see by historical standards, we're at a lower basis nowadays compared to 21, 22, 23. But compared to the trade war years of 2018 and 19, we're a little bit elevated. I want you to highlight that blue line, which is the PNW, which is our market. And I have to emphasize, we were at a period in 22, 23 of a PNW basis of plus $3. And if we went back into the era about 2014, 15, we were in that plus $3 range. Today, we're at a pretty solid plus $1. Okay, so that's pretty low by historical standards. You have to go back to 2018-19 to find values lower than that. Okay, so these are charts. This is St. Louis basis, which is really the benchmark in the United States. And I show it to you for the following reason. In the past few days, we've had a very sharp crash in the bases at all of the markets in the United States, including in North Dakota. And on the left-hand side, that's the spot basis at PNW. And you can see the very last line, if you can see my cursor, I don't know if you can or not, but you can see how the basis fell from about plus 20 to minus 20. So there's a 40-cent decline in the basis. And on the right-hand side, it's the basis for new crop, where you can see it fell here from about minus 10 to about minus 40. So that was just in the last few days. So the market is kind of catching up with this idea of the problems we're going to have in the storage and basis market this coming year. This is the way we analyze basis in my class. I'm going to use AIR and PNW for illustrations. And on the left-hand side, I show the basis in different years. And the right-hand side, I show the average and the volatility or the standard deviation of that basis. On the left-hand side, the black bold line is the longer-term average. So typically we'd say, well, we would expect to gravitate towards a longer-term average. The red line that is bolded is the current year. So this is an AIR very close to Castleton, is the current year, and a seasonal projection going forward at the current year. And I just show this to you because I want to highlight how we compare to previous years. Some of those years we had very high bases up in the area of plus 50 cents to $1 a bushel. Now we're at a pretty solid minus 60 in that range. However, we compare just about similarly to the previous trade war years. We're not quite there yet. I don't know if you can see the 2025 value there, the solid red line. We're right in the middle, but just above the previous trade war years. Here's the same thing at the Pacific Northwest, same depiction. On the right-hand side, I want to highlight to you during the month of July, that extreme standard deviation, that wide range there says during the month of July, there's a huge amount of risk or volatility or uncertainty over time about what that basis is going to be. And it doesn't solidify itself until we get into September and October. Well, the reason for that, we're approaching the end of the old crop in the United States, typically the end of the shipping season in Brazil, and we don't know for sure what the harvest condition is going to be in the northern tier part of the country. On the right-hand side, you can see that solid red line is the current basis at about plus $1. So that's slightly above the previous trade war years, but substantially below average and previous years prior to 2018. Okay, so now as the ADM is obviously the biggest buyer in the country and a big supporter of our students in our commodity trading room, and we have good friends there. And I communicate regularly with their traders and ask them to send me their current basis offers for buying grain. I do that in part because we have all the information in the world in our trading room, but it's never enough to know exactly what the current situation is. But I'm going to show you 3 slides, and there's a lesson here. That's why I'm doing it. So in 2022, when I gave this speech, I circled there their bids for buying P&W shuttles. And you can see their new crop bids were 225, 215 in that era. Okay, so remember that number. In 2024, last year, plus 135, 145, 150. Okay, so down slightly. Last week, it's a big blank. Okay, and he says to me by email, no soybean bids at all. Let's hope that changes. We need China pretty bad here for harvest. So they were not buying it. To my knowledge in my career, it's the first time there was no bid. There was no reported bids and no transactions on soybeans in the P&W. And that's a very, very, very big concern. Now, since then, that was last week, a couple days ago, this trade that was to Taiwan has not been yet reported in the data, but it seems as though it was inferred at about plus 135. So we talk about the forward curve, and in all commodities, there's a forward curve. Typically speaking, in a normal market, is positively sloped. Sometimes in an inverted market, it's going to be negatively sloped. We are blessed in North Dakota now to have 2 crushing plants that are highly competitive with each other, as well as with competing markets. And they put out, and we're fortunate for this, that they put out forward bids, both for cash prices as well as basis values. And these were the values from last week. And on the left-hand side, this would be the forward curve for the cash market value. You can see it goes to a low during September, October, and then thereafter it increases at a pretty healthy pace going forward out to February 2026. I think that's when they stop, and I'm guessing that's the reason they stopped there is because that's the beginning of crop development conditions in Brazil. The basis forward curve is shown on the right-hand side. Of course, the reason it's a positive slope is they want to provide an incentive for storage by growers. Okay, just to talk about Brazil for a moment, I know Frayne elaborated on it, but from a basis perspective, which is our focus now, this shows the basis between Brazil and the United States. The U.S. basis at the U.S. Gulf is the yellow line. The blue line is the brown line is the P&W basis. The red line is Argentina, and the blue line is Santos, Brazil. So you can see from January until just about now, U.S. premiums price basis values were higher than those of Brazil and Argentina. You can see they hit a low here in about March, and then they increased pretty sharply in the past few days, have gone above U.S. values. This blows it up. So this shows, Frayne had a similar chart to this, but I just want to emphasize a point. And this shows the CFR, that means delivered to China, basis values. The top part shows the flat price, and the bottom part shows the basis. I'll speak to the basis. So this blue line is the delivered price from Brazil, and the top line is the delivered price from the US Gulf. So you can see as we went into January of this year that Brazil went to a very sharp discount relative to the US Gulf and is now going up. And still, they're about a 40-cent lesser price than from the US Gulf, but it's starting to narrow somewhat. Okay. Now, this Brazil basis thing is pretty important, and this is a similar historical chart as we had. Typically, their basis is pretty flat January through June. That's the end of their harvest, and then their basis begins to appreciate. Normally, it peaks out in August and then begins to fall as our new crop comes on. And my experience is as their crops get larger, their peak basis ends up later in the marketing year. Now, briefly on the freight market. So we monitor the secondary markets values because they have such a big impact, both on our interior basis value as well as our export basis value. And we've been studying this forever, but I'll just share with you a few slides on it. This shows a history of the secondary market in dollars per car from 2016 until current. That blue line takes us right up until current. And you can see here that, typically ranges from about minus $200 a car to about plus $2,500, $3,000 a car. That's $1 a bushel, so that's a lot of money. Whereas recently it's fallen and is very close to zero. So that's pretty abnormally low for as we start approaching this part of the marketing year. This is pretty seasonal. It normally has a low in July and peaks out again in September and December. And I'll just show you current values. So today, this is from one of the companies. This is a brokerage company called Midseason, and their bids were about minus $100 this is for different periods forward, but minus $100 currently, peaking out in October, November, December at plus 600. Now, really, the range is 600 to 1,000. Okay, the average for that value over time is normally about $900. So this is kind of drifting towards the lower end of what that freight value will be. This is another brokerage company called Trade West. They're showing the values in October at about $700 a car, slightly less than normal. So we have, from a farmer or grower or shipper perspective, we have pretty attractive secondary market values compared to normal. Of course, the reason for that, I got to tell you, the reason for that, given the inter-month spreads, is anticipated there will be limited farmer selling or movement at harvest time. So in my class, we developed something I use as a teaching tool, and I want to share it just briefly. But okay, what does that mean for you? Because you as farmers, you got to do something. You either got to do something in the futures market, in the basis market, or in the cash market. And I want to kind of show you a little bit in today's value, the current values, what that means from a risk perspective. Now, this particular comparison uses Jamestown or Kensal, North Dakota, and I want to highlight it. So this shows some graphics at Jamestown. I think this is Columbia and Jamestown, I believe. And it shows in the upper left-hand side 60 days of cash and futures prices. And down below here, this is, I guess, Courtney, North Dakota. It shows the bases going from about minus 35 or 40 to minus $1, and now at about a pretty solid minus 60. This was a week ago. Now, we use the word standard deviation as a measure of risk, and I calculated over 21 days. And I want to highlight to you here that back in June, the amount of basis risk and futures risk was about the same. But since then, the basis risk has in fact fallen, but the futures risk has increased substantially. So what does that mean for you is the most important risk for you is now the futures price. The basis is still risky, but the futures price is the most important. In fact, by historical standard, that's a pretty high number. On the lower part here, I show the correlation between basis and futures. That's a negative number, minus 0.48. So what does that mean? It means if futures go down, basis goes up, or vice versa. Now that's a pretty important issue for a hedging strategy because if futures goes down, it's attracted to be selling futures. And if futures go down, the basis goes up. So if you're hedged, you gain from the futures decline and from the anticipated basis appreciation. So we calculate this. There's a lot of calculations here. Don't worry about it, but it's a representative farmer around Jamestown. It's got 50,000 bushels, and this is their cost of production, 239,000. And I'm going to show to you three different strategies. The first one, if we're 100% hedged, our profit is $214,000, and our standard deviation is $2,900. If we're 50% hedged in a 50% basis contract, our standard deviation goes to 4635. If we're 100% unhedged, our standard deviation is 9200. So by hedging, we reduce our risk of our market strategy from 9270 to 2900. We don't eliminate the risk because we still have basis risk, but we reduce it by about 2/3. Now you'll notice here, the profit in all three cases is the same. Well, I'm assuming the market is pretty efficient and you can't outguess the market. Maybe Frank can, but we can't outguess the market. So the profit level is the same, assuming the futures market is efficient. But what we do by managing our risk is ultimately reduce the risk of our portfolio. Just to illustrate this over time, and I won't get too hung up on this, but we're pretty big on measuring this risk. In 2022, the basis risk was 56 cents. In 24, it was 20 cents. Today, it's 6 cents. That means there's hardly any basis risk compared to previous years. Similarly, in futures, it went from 77 cents to 42 cents to 21 cents. So people talk about how we make projections in the basis. We use the MACD, which is a tool Frank talked about in futures, but we apply it to the basis values as well as, and we do seasonal indexes. So this is the MACD. This is what it looks like, but Frank taught it to you already. And so here would be the P&W basis. And you saw this slide before, but applying that methodology, then we start pushing up the P&W basis into a peak in about September and then moderating down into October as the southern part of this country starts harvesting. In the basis for air, we see a decline in the basis and probably pretty flat to declining over the next few months. Now, these guys at Illinois, this is an older study. We've done it here in other commodities, but we haven't done it in soybeans. But they wanted to say, what is the most likely month for the seasonal low in soybeans? And what is the most likely month for the seasonal high in soybeans for the basis? The numbers are exactly true here as well, I believe. And what this says is the percentage of the time that October is a seasonal low. It says that 30% of the time, the basis reaches a low in October. So the most likely month that the basis is going to be low or at a bottom is in October. And the most likely month that will be peaked is in August. So that coincides with the figures I showed you earlier. Now, having said what I just said, I was out for dinner the other night and I met a former student of mine who is at Enderlin PGA. And he told me that they've dropped their basis substantially. And I asked him why, and he gave me a lot of reasons why. Lack of storage, farmers having storage constraints, labor constraints, and anticipated a big corn crop. And so he lowered their basis. So that was earlier this week when their basis was shown here at about minus 80. And I went to DTN and looked it up, and they lowered the basis here to minus $1. So in one day, they lowered the basis 20 cents. So by historical standards, this would be a record low or approaching a record low for new crop bases in North Dakota. I'm not picking on Enderlin because I suspect if we looked at all of the stations in North Dakota, we would have seen a similar drop. Now, my interpretation of that is as we start approaching harvest, the market's looking for a bottom, and that's where the market's searching right now. Now, to be sure, this is what happened to the bases in Jamestown. Went from about -85 to -$1, same calculation. And here's the one at Castleton Maple River. They haven't changed, I'm going to say yet. Maybe they will, maybe they won't. Okay, so what does the outlook look like? I'm guessing, this is just a guess, that well, I know futures are low, but very high risk. Basis currently is abnormally low due just about exclusively to the lack of exports. And the risk of basis is near nil. An important characteristic this year is we got extremely wide carrying charges in the futures market. By historical standards, these are as wide as it ever gets. And it certainly puts you in a situation where it would nearly cover the full cost of storage into deferred months. So what's it look like? It says future spreads are wide. When future spreads are wide, then farmers, traders, and processors and importers will store as much as they can. Every one of those are going to be buying soybeans and selling deferred months because nearby is cheap. Eventually, they're going to get their storage filled and all the soybeans will be coming off the market. Once it's off the market, then there's going to be upward pressure on the bases, the purpose being to induce soybeans to come out of storage. So my prediction is we will see downward pressure on the bases for a while. At some point, it's going to bottom out. Everybody's going to be storing. Nobody's going to be selling cash. And then the bases will have to appreciate to offset the abnormally wide carrying charge in the futures market. Okay, with that, I close, and I'd be happy to hold on here. Happy to try to answer questions.
All right, thanks, Dr. Wilson.
Yep.
Just getting our next speaker ready here. So any questions for Dr. Wilson, again, can go into the chat, or you can come off of mute. I'm just seeing if anyone's coming off. I know you covered a lot of important and timely issues to watch coming into this trade season, so appreciate that.
This probably kind of sounds like all bad news, but
yeah, I I don't have a more optimistic comment, I suppose. Seeing no questions, I think we will pivot. Dave, I think I got you in the room here. I'll have you come off of mute.
You sure do, yep.
Perfect. All right. If you want to, Bill, can I have you stopped
Yep.
sharing, please? And then we'll have Dave pull up his slides. So Dave Spickler comes to us out of Lighthouse Commodities in Bismarck. He is a farm merchandiser who's been busy this morning checking the markets and doing his job outside of this event. So he's got very updated content for us, I'm sure. So with that, Dave, once you get pulled up here, I'll hand it over to you. I see your slides. You just have to start the slideshow.
All right. This is weird how Zoom does it. I still just see a viewing screen. Does that you're seeing my slides all right then?
Yep, I see a title slide that says Lighthouse Commodities, and I just saw it switch.
All right. Well, thank you, and thanks to the Soybean Council for the chance to come and share a little bit. And I have a real quick set of things to do here as you've looked at a market outlook and looked at a kind of a basis outlook and whatnot, just to talk a little bit about how to approach some of this now, what to do with a setup like this, because I think the biggest challenge you get when when markets are depressed like this is the tendency can be to not want to make any decisions. And there's actually some pretty clear things that there's some value to the clarity we're getting out of these markets right now. It actually makes some decisions easier. The outcomes are not always great, but the decisions, the high probability decisions, actually become clearer based on some of what we're knowing now. So I just want to share quick about Lighthouse. Just main reason just being, if we're strangers on this webinar, should you listen to anything I have to say? Why does it matter? Where are we coming from with the insight that we're sharing? So Lighthouse was founded in 2015. We're based out of Bismarck, North Dakota. We work with clients all over the Dakotas, Nebraska, Montana, Minnesota, Wisconsin, and increasingly Ohio and in the Eastern Corn Belt. Basically what Lighthouse does, we come alongside a farm and just equip you to merchandise your grain just like the rest of the grain supply chain does, to professionally merchandise this grain. So the planning, hedging, and cash trading of that grain, we work for you as your merchandiser on staff. On the planning side, we have a full analytics department. We do our own internal fundamental research. We're one of the very few grain advisories that does that on their own. We also are the only one that we know of that has a full quantitative analytics department. So we have a PhD quantitative analyst on staff. We have 2 software engineers. The only things, well, software engineers do a bunch of stuff for us, but one of the main things they do is work on quantitative, like numbers, algorithms, that sort of understanding of these markets. So we're not making feelings-based decisions and whatnot. And that feeds into some of what we'll talk about today and some of how we provide value for our clients. And just for some context of what we've been up to with this business model, since 2015, we've traded over 200 million bushel of grain. We at our size right now, we'll market about 55 to 60 million bushel of grain in this crop year, just depending on yields. Generated over $2 billion in gross sales, and we market a little over 850,000 acres annually. And again, the main sharing of all this is just some of the context of where we come from on these thoughts, what informs these opinions and whatnot. So market overview, I can do this real quick in this instance. There's only about 2 things that actually matter right now. So I can restate some of the deeper dive that we've heard earlier. And then the big thing to spend some time on is just how to navigate this. What do you do on a farm perspective if you're looking at the bushels I have coming this way, the marketing decisions I've made so far, the amount of storage I have, my cash flow timing, and what the markets are telling us about futures price, carry on the board and basis. So just talking a little bit, spending most of our time just talking about what to do there. If you look at where we're at in the markets, some of this was maybe shared or the same context already. This chart on the screen just shows cumulative precip weighted to the corn growing region of the U.S. Soybean region would be similar, and it would tell the same story. But basically, just you had a dry spring that facilitated really timely planting across the Corn Belt, and then you've had a linear, almost perfectly linear precip pattern since then. So no huge range, just nice timely rains running a precip surplus through this point in the growing season. You've also had, for the most part, moderate temperatures. When you have this, you do not have crop issues. You don't have supply side issues. This type of weather, it would have to be the one exception in my career is in 2020 when you had a derecho storm that wiped out a 100-mile strip of Iowa in late August. Otherwise, you get to the finish line with trend or above trend yields when you have weather like this. And this ties into if you're looking at analyzing grain markets in the growing season in the Northern Hemisphere, you can ask yourself, is the weather that's happened so far and the weather that's forecast right now, is it making the crop bigger or is it making the crop smaller? And if it's making the crop bigger, it's almost impossible for grains to rally no matter what else is going on fundamentally across the world. And this is certainly a forecast we've had through the whole growing season where the weather is making the crop bigger, if you will, to use that simple of context for it. The other challenge is the trade war uncertainty has put us in an even more precarious spot than a year ago on soybean demand. If you look at at corn and wheat demand, is actually, at least export demand, is actually quite impressive. We're at multi-year highs for new crop export sales, but soybeans are actually trailing year-ago levels for the worst pace we've been off to since the trade war year in 2018. And more importantly, the window is closing, or at least for October, is already closed on getting old crop export sales, or getting new crop export sales done to China in this Q4 window. So that's, you've got, weather that's making it tough to rally, and you don't have a demand story. And then if you look at corn and wheat, unlike a year ago, you're already factoring in huge export numbers on the corn balance sheet for new crop. They look like they're going to be achieved, but it's not going to be like a year ago where you started with a too low of export number and just kept revising it higher, and that really helped the market rally and whatnot. So if you look at this, that's kind of the bad news, if you will, but also it's news. In other words, it's stuff that's been traded. The market's already traded the very favorable weather and the idea that we're going to have a demand problem, at least on soybeans, going forward with all the trade war uncertainty. So that's priced in. If you look at a grain chart right now, you're actually angling for, most of the time in these big crop years, you make your seasonal lows in mid-August to mid-September. It's actually very unusual to actually make those lows in harvest. And if you do, it's usually not much lower than where you were already at in mid-August to mid-September. Basically, you make your lows once you've priced in as big as this crop is going to be. And that usually happens well in advance of harvest. So August WASDE report on Tuesday, we'll see a revision higher on yield. Markets trading something in the 185 area for corn yield, mid like 53.5-ish for beans, 53.5-ish. No matter what we get in that August report, the trade will likely price in that news, and you'll be at or near what amounts to a significant seasonal low. And as South America has overtaken the US pretty emphatically in soybean production, your whole soybean seasonal is different now. You tend to make a minor peak, if you will, in early summer that coincides with corn's seasonal high. You tend to fall into this September timeframe, and then you actually have a much more significant fall-winter rally that coincides with South American weather risk. If you think about harvest last year on soybeans, that last October was the highest soybean prices we've had in the last year. That was right in the middle of our harvest, but it was planting delay worries for South America. So you have a strong seasonal tendency for soybeans to rally from this time frame into around the 1st of March or so, and this seasonal is being followed pretty quickly. So this is important. A lot of grain marketing decisions get made based off feelings, and most of the time that's bad, because most of the time your feelings are wrong. And right now it's starting to feel like all this news is bearish, the markets are going to fall. You're just catching up to it. Like, this has all been traded in. We're in range of what should be a significant seasonal low and some degree of rally. Here's the other counterpoint to this, and it's not necessarily good news, but it's helpful news. This chart is showing the July futures contract for corn of the crop year that you're in, going back to the big crop years since 2009. So July of 26, as it relates to this year. In 2009, it would have been July of 2010. And basically just showing the price on August 1st, and then the highest price between August 1st and June 30th. And using that July of next year contract to mute out the effect of carry, because that skews these numbers quite a bit. So this says, if this was my price on August 1st, what kind of rally can I expect between now and next June when I have a big crop like this? And last year we had an 86-cent rally in corn, the largest rally ever for a big crop year. And where did that come from? It came in part from massively understated demand and several consecutive WASDE updates where exports were increased, and kind of a phantom out of left field yield reduction in the Jan WASDE report. So two to abnormal conditions that were both very bullish, and even then all we got was an 86-cent rally. Otherwise, your rallies have been somewhere between 7 and 60 cents. And this is the takeaway in this. When you have a big crop like we have now, you don't rally $4 the next winter. You in most years, your rally is somewhere between 20 and 60 cents and again, this is not accounting for carry. This is just any standalone futures reference month. So that gives us some useful insight. We know two things now that are helpful. We know we're at or near major seasonal lows, and we know that a rally on corn most likely will be between 25 and 60 cents, beans between 50 and 100 cents. Those are, again, not necessarily good news, but two helpful things as we look at what to do next. So just talking about how to navigate this, if I'm a grower and needing to start making some decisions, there's basically three things, and this applies always, but it definitely applies now, because in 2022, if you didn't have realistic hedge targets, you still made money. You could have been the worst market. You could have sold the lows of everything and still made money. In 2025, decisions on these three bullet points are the difference between positive and negative cash flow in the upcoming year. So realistic hedge targets. How do we get to realistic hedge targets? We just kind of set the stage for that before, having some context of what's likely to happen, and then having, this sounds really rudimentary, but just having those orders working where they should be working. I've bought, between Lighthouse and my life before Lighthouse, upwards of 500 million bushel of grain in my career to date. And every single time I've talked to a farmer, any day, no matter what, in these markets, through two bear cycles, two bull market cycles, the price the farmer wants for corn today is just a little bit more. It doesn't matter if the price is $8 corn or $3 corn, they just want a little more. Hedge targets get you to sell grain you wouldn't have sold otherwise. I also talk, coming back to the feeling side of this, in my career, all of the good hedging decisions we've made over the years, when we make them, we feel regret, because the market's rallying. Oh, I just filled this order, I don't know if I should do it. All of the bad hedge decisions we've made, when we make them, we feel relief. Oh, the market, I can't watch this market fall anymore. Oh, corn's down below $4. Oh, I'm just relieved to have it sold. Those feelings are lying to you. They're disingenuous. So relying on feelings, not having a plan, trying to watch the markets, it's not, the odds that you have a successful hedge become quite low. So realistic hedge targets, we talked about just the range we should expect, 25 to 50 cent rally from today's price on corn. It's very high probability that we have at least that much rally, low probability that more than that. At Lighthouse, we also use our quantitative analytics to help us determine, beyond just that target, exactly when we need to step in and execute and all that. So this is, I'm going to try, if I can. Are you seeing, I just switched to an image from my PDF. Are you seeing that? I don't see what's on screen. So do you see just what's labeled as an image? Can somebody just confirm you're seeing on the screen?
Yep. I
Okay,
see. Yep, I see images on the screen.
Perfect. That's exciting. So this is an example. This is actually on February 20th. This is backdated then, but this is what went out live that day. So February 20th, we're at our what ended up being the highs for the year on corn. Our signal analytic was at the sell threshold. You can see here above the sell threshold line. We also have 5 individual quantitative analyst gauges, 99, 100, 53, 100. Only price to stocks to use was lower. These analytics can make it really easy to decide whether to buy or sell. Like if I'm looking and saying 475 corn at the time, that sounds pretty good, but I don't know what to think next. Well, our analytics are saying there's a high probability that this is a good time to sell. Look at what our signal line, it's above the sell threshold. Look at these gauges, how high they are. So again, this is not a pitch for Lighthouse. We got plenty going on as it is. This is more just having some sort of quantitative way you look at the market to say, is my hedge target still a good one? Should I stick with it? Should I lower it? But moving on, as far as what to ship and what to store, this is where there's significant differences this year because of the soybean situation. Right now, you've got 62 cents of board carry on soybeans out from harvest to July, where you only have 34 cents of corn carry. That corn carry is still pretty good, but bean carry is record wide, and this is just board carry. If we plug this into a storage calculator and make some assumptions on that carry, harvest basis, deferred basis, and then our cost of carrying, you actually have very historically quite good harvest corn basis right now, and you have incredibly poor soybean basis. So right now, if I'm storing in my bin, I've got a net return of 54 cents a bushel on a bushel of soybeans that I store till next summer. On corn, I only have a net return of a dime. And again, there's some assumptions in this, but in the case of soybeans, these are processor bids that are in the market already and stuff. So you have if I've got a bin and I'm wondering what to put in it and I can't put everything in it, I've got 5 times the return on storing a bin of soybeans as a bin of corn. And this is atypical. Normally it makes sense. Any space that we are short, we just move beans. So thinking about that, and then the other side of it is if the stuff I need to move at harvest, and maybe I need to move a chunk of corn now instead of soybeans, getting that basis set proactively, making sure not to just wait until the middle of harvest. Right now, today, you're seeing where elevators are realizing maybe they're not going to have bean trains to fill. They've got committed freight. They're wanting to make sure they get corn to fill those trains, but we get to the middle of corn harvest and there's going to be corn coming from everywhere. So looking at this and saying, how much grain can I store? What needs to move at harvest? Look at these return advantages. The soybeans, I'm going to store beans. That means I need to move some corn at harvest that maybe I don't normally move. And that means I probably need to pick up the phone now and start thinking about getting my harvest basis set while it's still historically quite decent on corn. So that's kind of the conclusions here, I guess, just in a quick run through of what's going on in the markets and how to approach this, how to navigate it from a merchandising perspective. I think it's important to note your break evens are likely improving somewhat if you've got better than expected yields, and that varies somewhat as we travel across the state, but there's sure regions of the state that are going to be above normal on corn and soybean yields. So your break evens can drop significantly. That makes this easier to navigate. Having realistic hedging targets, setting those targets based off analytics and monitoring them based off analytics, leaving the emotion to something other than grain trading, figuring out your harvest movement, what my space is. A lot of people were impacted by these storms. If that changes your calculations based off bin storage, it looks like we get to do another one of those storms tonight out where I'm at and up north of here, just how that impacts things. And then, setting basis well in advance of shipping. Don't wait till the middle of harvest to set that harvest basis. And then just looking at the carry math and maybe storing soybeans instead of corn, instead of moving soybeans into the worst ever harvest basis. And just kind of final thought on all that. We've seen this play out before, and you'll definitely, if there is no P&W harvest movement on beans, you're not altering total global soybean demand by one single bushel. That's not demand that is lost globally. What you're disrupting is trade flows, and the whole supply chain works together to solve that. Now, the railroads say, well, I had hundreds of freight movements I didn't do out to the P&W. I'm going to put a rate from North Dakota into some of the interior soybean crushers. And then you start seeing atypical moves. Like we saw this in 2018 during the trade war, where North Dakota beans went south instead of west. all of that stuff will start to develop and there'll be opportunity. And then obviously you have crushers that need half of the beans that we grow just to supply their plants through the year, but they can take 2 weeks worth at harvest. So they've got a big incentive to pay you to carry these beans in any year. And we didn't have that in 2018. Again, if you move away from bean harvest, we'll have realistic merchandising targets. We just got to navigate this harvest window. That's the number one thing here today. So that's kind of my overview and whatnot. Again, webinar in the history of webinars I've done, there's maybe been 2 questions ever. So I certainly won't be offended if there are 0 again today, but I'm happy to answer any questions or any discussion at this point. But that's kind of my thoughts I had. So.
Well, thanks, Dave. Appreciate that perspective. I'm looking for questions in the chat or somebody coming off mute to ask a question. I know we've got Mark on. Mark, we're a little early on time. Would you be okay if we started at 10:50 instead of 11? Maybe Mark stepped away getting ready for his. I'll get a hold of Mark and we'll go from there. So let's come back at 10:50. Dave, are you staying on or are you jumping off? Just so I know where to send questions if people have them.
Sorry. Yep, I'm available.
Okay, that's wonderful. We'll have you start at 10:50, Mark. Thanks.
I might have to jump
Sure.
off. I'm in the middle of the trading day here, so this is everyone has about 10 more seconds here if you want to ask me a
That sounds
question.
great.
Otherwise, you'll have to hang on to it for
All
forever.
right. Last chance, but I don't see anything coming in. So,
Very,
all right. Well,
very
with
good.
that,
Thank
thanks,
you.
Dave. We will break until 10:50, and then we'll have Mark give us the weather outlook right as we close. Thanks, everybody. Mark, if you're on, we can get your slides pulled up so we're ready to go here. All right, that looks good on my end. You just have to start the slideshow.
I have to unmute myself
For that
too.
too.
Well, maybe they don't want to listen to me. All right. And
If you go up to slideshow
slideshow, I know it's up there somewhere.
from beginning, there you go. Looks
Hey,
great.
look at that.
Perfect.
Jace, you can teach an old dog new tricks.
With that, it is 10:50. So if you want to get started, Mark, I'm going to hand it over to you. Again, Mark Ewens comes to us from Grand Forks. He's meteorologist for KNOX. And he's done this for us. I think this is your third or fourth year doing this event. So always appreciate your insights and look forward to what you have to say. I'll hand it over.
All right. Thank you very much, Jenna. And thank you all. I've been listening through the morning. And Frayne, I think that forecasting the weather is simple compared to doing uh, crop analysis and forecasting. You've got a harder challenge, I would say. I can at least say that our science is up in the air. Okay, that's all the jokes I'll try this morning. Yes, I am retired from the National Weather Service. For those of you who don't know me, I retired from the National Weather Service in 2014. I am the owner operator, as it says, of Home on the Prairie Weather, which is the auspices with which I do these type of presentations. I am also the 3 to 6 host on KNOX radio here in Grand Forks in the afternoons, and I love talking about agriculture. It's one of my top topics, and especially weather and how agriculture and weather are so intertwined. Uh, to jump into it now so I can keep us moving along, I like to do my little caveat emptor because I use a wide variety of data sources. I think one of the cardinal sins I've been told in doing presentations is to keep everything consistent across the board. Well, I do break that rule on a regular basis because I like to show the data in the native format and environment which it is displayed. So you'll notice some inconsistency on some of the graphs, but the data are valid. And I sometimes follow the conventional rules, sometimes not so much because some of my theorems are outside of the conventional wisdom. Now, I learned that those of you might remember Dr. John Enns, state climatologist of North Dakota. Unfortunately, we lost John recently. He was my mentor and advisor in my stint at NDSU a few centuries ago when I first started getting into the agricultural realm of climatology. And he taught me a great deal about following the data, regardless of what you might think what the science tells you, because the science is in the data. And as I say in the very bottom, if you've got questions, comments, or suggestions, don't be afraid to voice them. After 50 years in weather, having raised 5 sons, and now being in the talk show business, I've got pretty thick skin. So it's fun. I wanted to throw this up. This is kind of a new slide. I just put this up here because since we're talking agriculture, I know a lot of you are interested in the upcoming severe weather event. This is the latest information from the Storm Prediction Center, the latest graphic on the left side for the next 24 hours through for the next 18 hours through the evening. This is the highest risk, kind of Minot, Bismarck down towards Fargo. On the right side, it shifts to the east for the overnight into tomorrow. The greatest risk, according to the Storm Prediction Center, is everyone's favorite, hail. And wind is the secondary risk. They do rate tornadoes as the relative lowest risk. So from the synoptic standpoint, this bears a lot of similarity to that June event from the derecho that caused all the damage along the I-94 corridor. Not saying that's going to happen. Weather rarely repeats itself precisely, but that is how the atmosphere is currently shaping up. A great deal of humidity, a very unstable atmosphere, and a very strong wave coming across. So we'll see how the system develops. Now, I call it data by division because in the climatology side of meteorology, we break all states down into 9 distinct climate divisions. And here you see North Dakota and Minnesota. So a lot of the data I'll be talking about for this presentation's purposes are climate divisions 3, 6, and 9 on the North Dakota side, 1 and 4 on the Minnesota side. Relatively large areas, generally the climate is homogeneous across these areas. Climate Division 9 over southeastern North Dakota, there's a bit of disparity more so between Richland, Logan, and McIntosh counties. But for the intent of the changing climate and the purposes of the discussion, there's enough commonality that it works fairly well. Same thing, Climate Division 1 and 4 on the Minnesota side, from Chippewa County down in the south to Kitson County in the north. Sometimes some pretty big differences in the winter months, especially, but over the 30-year climate normal periods, they're relatively similar. Now, this is an aggregate of those climate divisions, temperature. We've been recording hard data in the region since the mid 1890s. So the red line is the annual average temperature across the entire region. The polynomial is, well, the third order polynomial tracking the changes. And the blue line, I believe, is the 7-year running mean. Now, we use 7-year running means in temperature to kind of get a pseudo partial decadal change. And as one can see, especially from the mid 70s, late 70s on, we've had a relatively steady rise in temperature. Now, for those of us of a certain age that grew up in the 50s, 60s, and 70s, we lived in this realm where the climate was relatively steady. And so when I started into the world of climatological forecasting, that's kind of the mindset we come from. Yeah, climate's relatively steady, doesn't change that much. We also didn't have a whole lot of knowledge about what happens in elsewheres across the oceans, in particular the ENSO region. Quickly going to precipitation, basically the same thing. The variability in precipitation, these green lines represent the annual total precipitation across those aggregate climate divisions. The polynomial showing that we've been in a wet cycle the last roughly 20 years, since the late 80s into where we are now, 30 years, we've been in this relatively wet cycles that started in 93, really. We're now starting to trend back down. We're seeing the net average precipitation coming down, but obviously still having some areas of extraordinary rainfall. Within the Red River Valley, for example, right along the US 2 corridor up here in the Northern Valley, we're very wet, but I'll show you some data where not too far to the north of us, they're wishing for rain. So the US Drought Monitor I saw earlier is kind of a wide average of what the climate is. Now, this unanticipated surge, for those of you who weren't here last year, I talk about the eruption of the volcano that occurred on January the 15th, 2022. The Tonga eruption sent approximately 146 teragrams, that's 146 trillion grams of water vapor into the Earth's stratosphere. That's the next layer up. This eruption was a subterranean eruption. Had it been above the ground, it would have been, who knows the amount of dust it would have put into the regular atmosphere where we live here in the troposphere. But that's essentially the water vapor scientists estimate the 1991 Mount Pinatubo in the Philippines. Yeah, it's 4 times more than what Pinatubo did, and that had a fairly significant change to the climate. Now, water vapor in the stratosphere is an incredible heat trapping gas. When it's in the troposphere, which it has to go through and is still there, is part of the reason why we're seeing some of the extraordinary rainfalls that have developed globally in the last few years. Now, yes, climate change is real, obviously. The carbon dioxide is a part of the process, but regardless of how much you heat the atmosphere without the fuel of water vapor, you don't necessarily get the big increases that we've seen. So some of the recent mega storms that have occurred since 2022 are directly a result of the Tonga volcanic eruption. On the left-hand side of this screen, I took some data from the National Center of Atmospheric Research in Boulder, NCAR. Perhaps some of you have heard of it. The two top graphs, the very top graph is the specific humidity at 700 millibars, roughly 10,000 feet above ground level. The second graph down is the precipitable water, total precipitable water in the atmosphere. And with the warming climate, the precipitable water has been creeping up, but this increase that occurred after the Tonga eruption, coincident with the great rise of moisture, specific humidity at 700 millibars, gives you an idea of how the increase in water vapor has been just phenomenal. Uh, this also from NCAR, the 2 meter temperature, and you can see the 2 meter temperature across the, I believe this is, yeah, this is the northern hemisphere as well, that it's been steadily rising, a bit of a leveling off lately. So the increased water vapor didn't immediately affect the temperature. And across the southern hemisphere, the same kind of a thing where we're seeing temperatures go up. So more extreme weather. The increased moisture will fuel stronger storms, heavier rainfalls, more intense hurricanes. Now, drier droughts are also possible because when you have larger storms in part of the atmosphere, by default, that takes moisture from elsewhere in the atmosphere. For all this homogeneity we talk about in weather, obviously very discrete systems. And so these things are very different droughts and wet cycles, and we'll see those continue to be exacerbated as this moisture works its way through the system. Now, when I started doing climate prediction, I talk about the alphabet soup of weather prediction, climate prediction. The El Nino Southern Oscillation, the ENSO, that was pretty much the only thing we really knew about in the 1980s. We had ideas of the other oceanic systems, but didn't have a good grip on them. The ENSO was relatively well understood. So when the Climate Prediction Center started to do some of its early climate predictions out 3, 6, 9 months into the future, using just the ENSO region, there was some early successes. And we thought, boy, we've discovered something great here. After 3 or 4 cycles of early successes, we had some absolutely horrible failures, climate predictions that were as far wrong as they could possibly be, literally the opposite side of the coin. As the deployment of more and more remote technology has continued to expand, atmosphere, oceanic, we've learned so much more. So this alphabet soup represents kind of where we stand right now within our understanding. We've got the North Atlantic Oscillation, the Atlantic multi-decadal oscillation, the quasi-biennial oscillation, which is a biennial reversal of the stratospheric wind above the equator. We've got the Indian Ocean dipole, the Madden-Julian oscillation, regular pulses of thunderstorm clusters that originate in the Indian Ocean area and then track across the equator and do a circuit around the globe. They affect the weather dramatically in the northern and central latitudes. We're just finding these things out. The Pacific decadal oscillation, the East Pacific, North Pacific, on and on and on and on. We're learning all of how these interact. Sometimes they phase together to create massive systems. Sometimes they combat one another and basically struggle for dominance and cause quieter weather systems. Now, so in many ways, the sea surface temperature anomalies have been fairly steady across the globe in the past year. We've had a relatively cool equatorial Pacific, kind of a weak phase cool ENSO, not quite La Nina, but in that realm. But what interestingly enough is that we're also seeing extremely warm water in the North Pacific from Kamchatka almost to the northwest coast of the United States and Canada. We're not quite sure where this extraordinarily warm water is coming from. Some theorize it could be some of the subsurface volcanic eruptions. There may be other things that are going on, but this warm water upwelling, when combined with the colder waters along the equatorial Pacific, are a very strong dipole that suggest the weather that we've been having, will continue relatively unabated. These are two of the main drivers for the Northern Hemisphere. Since weather flows approximately from the west to the east, the warmer waters west of us will generate storm systems that come this way. The Atlantic has impacts more on Europe, the Indian Ocean, and those systems more on Australia. Now, we're headed to something which I think may be in an entirely different type of El Nino or La Nina called the Modoki. This may be a Nodoki Enso winter, and the term basically means similar but different. And unlike the canonical ENSO, where there's typically warm or cold water from the equatorial South American coast out into the Pacific, this is where you have in a La Nina Modoki, colder water near the date line, but warmer water near the South American coast. You flip that for Modoki El Nino, where there's warmer water in the Central Pacific and colder water. So there's a break, and that causes a dipole pattern to develop in the Pacific, which affects the way weather systems form and move. So all these interactions are going on all the time. So suddenly forecasting futures to me looks far more appealing than trying to predict the climate. Now, history is a guide. This gives us an idea of where we've been and where we probably are headed. These two graphics, the one on the left is the mean April through September 2004 to 2024, taking out 1984 to 2004. So those two periods, we're taking the difference between the two, and where there had been cooling across portions of the northern plains, we were kind of the odd people out globally. We're starting to show some minor warming across portions of the Dakotas back into Wyoming and South Dakota, Colorado, into Montana, where it's a little greater, but we're still a relative minimum. The same thing with the October through March time period. We're warming, but not at the same rate. A lot of us think that's probably tied to precipitation. And we can see that looking at the same thing. This slide shows where the precipitation April to September. So kind of the growing season. I think a lot of you might say, yep, it certainly has been wetter. So in the very broad scale, we've seen significant increases in precipitation through much of the plains, the northern plains in particular, the central plains as well during the growing season. But October through March, the winter, the cool season, as we call it in the climate world, we've still seen some increases, but it's a little more less noticeable. And there actually are some areas that have shown drier. I don't know how this matches up with your personal experience or data sets, but this is the information that I pull from the Global Precipitation Climate Center. And they all work together with the National Weather Service and other entities to collect data. Now, I think Frayne was talking earlier about some of the drought monitor. I don't know how many of you might be familiar with the short-term prediction research and transition tool from NASA, but these are images, these are satellite-derived moisture, so real-time. It's a research program, but this shows the amount of relative saturation in moisture profiles, and upper left is from 0 to 10 centimeters, down to 100 centimeters, 200 centimeters. The top row shows the moisture percentile, so you get an idea of where there's been exceptionally heavy precipitation totals in the relative near future saturating the topsoils, but that hasn't percolated down necessarily lower, so you can see where the consistent higher rainfalls have been, mostly along that I-94 US 200 corridor. The bottom graph is the mean difference in the column radiative soil moisture, relative soil moisture, excuse me. And so the same basic principle where it shows where soil moisture is lower in a percentage wise. And again, these are satellite derived. So a lot of times I'll talk to folks in the ag world and say, how does this match up with your real world? How does this match up against NDON and their soil probes? So this is kind of experimental. They're still working on it. I look at the data regularly and I encourage you to look at it. And I know that NASA likes feedback. I think many of us are kind of familiar with the VegeDry program, which gives an idea of how much soil moisture there is or how the vegetation health is. So this is just another tool that I use, and I know a lot of us in the climate world, and I'm sure some of you in the ag world as well, to kind of get an idea on the health of the and the moisture content. So another view showing and the tools that we use for determining drought or the lack thereof. So this is the vegetation VegeDry from the USGS, the end of July, 21st to the 27th. Gross scale soil moisture, another way we look at the data from different perspectives. There's the soil moisture profile. Now, this is more of a calculated soil moisture profile from an ensemble model. The climate forecast system, many of you have heard of the American CFS, one of the many tools we use. And I'm taking some time to go through the analysis side of it because I always ask those of you in the agricultural world who are actually doing the work, does this make sense to you? Are these too dry, too wet? So the upper left-hand graph is from one particular site, NOAA, and that's not the old National Oceanic and Atmospheric Administration. That is a NOAA model. That is one designed to pick a particular type of re-radiative sensing. The other one is an ensemble mean CFS, NOAA, several different ones. Again, tools that we use to look at 30-day average soil moisture profiles. Now, this is the outlook from the climate forecast system. This is version 2 of the CFS, which is a newer model, been around for a while. One of the components of the model is to predict soil moisture over long periods of time. And it's a rather gross scale model, but you can see it's predicting for the August, September, and October timeframe, the dry conditions to remain over northern parts of North Dakota with neutral conditions south and wet conditions over northern Iowa, southern Minnesota. And as we get into the October, November timeframe, December timeframe, still dry with wet. So it shows essentially the conditions remaining where they are right now. So this is one of the outlook tools that we use. I think Frayne, somebody did show the drought analysis and outlook, so I won't spend much time on this, but I don't know if you're aware of the seasonal drought outlooks. I'm sure most of you are. These are produced monthly as well, valid for a 3-month period. So these are the latest ones issued near the end of each month. So just another one of the many tools we use to keep track of the climate. Also, the Weather Service, in cooperation with several other entities, produced something known as the Standardized Precipitation Index. And this is the number of standard deviations from observed precipitation totals over long-term averages over discrete time frames from 1 month to 36 months. It's another way we look at drought intensity to get an idea. Is this a transient drought that would be easily broken? Is this a significant drought that would take much longer to break? So it gives us an idea when we're talking to our friends on the ag side of the house. Well, normal precipitation is forecast the second half of the summer. It should ease the drought conditions. Now, the climate recap this spring and summer, I think everybody's fairly well aware of. This is mostly NDON data and other sites that comes into this graphic from the NOAA Regional Climate Center in Lincoln, Nebraska. NOAA, in cooperation with several universities across the United States, have these regional climate centers. If you're not aware of these data sets, just Google up the NOAA regional climate centers and you'll find a wealth of climate information. The top left is the departure from normal temperatures from the 1st of May through the end of July. Similarly, percent of normal precipitation. So it's a relatively grosser scale, and I know we've had some precipitation in August, but again, it gives us an idea of where the higher and drier areas are. So it's another tool that we use to go ahead and make sense of what the climate is doing. These two graphs on the bottom are the beginning of the forecast process because I look at analog years to come up with an approximate, the best fit. It's not a perfect fit by any means, but it's a best fit looking at where the relative climate in past years matches the current climate based on the ocean atmospheric signals I talked about earlier, and then what those expectations are looking 3, 6, 9 months into the future. The beauty of using something of a simple analog technique like this, because of the tidal nature of the atmosphere, is you do tend to have these periods that move into the future for several months and carry the weather with it. So it is a handy way of coming up with kind of a quick and dirty climate outlook. So getting to the fall 2025 and then winter 25-26 first guess outlooks, September through November, temperatures averaging on the warmer side of normal to continue. And this is the precipitation. Now, don't get messed up by the scales because the green in this case is actually deficits. So it would be warmer and drier up and down the Red River Valley, warmer and wetter where the blue is. So generally normal precipitation over the western Dakotas into Wyoming, eastern Montana would be a little wetter than normal. Parts of the upper Great Lakes and northeast Minnesota should be wet, but the valley region down into the plains should be drier and warmer than normal. Following the same technique, December into January and February, and I do believe I might have mislabeled this because this is supposed to be, yes, DJF. So December, January, and February, I mislabeled this, showing because expecting a El Nino, it's going to be a weak El Nino, but that combined with the other alphabet soup signals in the Atlantic and the Pacific should force a relatively cooler, seasonally wet, snowy winter across the plains, probably drier over northwestern sections of North Dakota, with the heavier precipitation in general terms about where it's been this summer. So the patterns seem to be broadly locked in. Here is the sea surface temperature forecast based on the canonical years that I've used. It doesn't show much warming along the South American coast, but it does show the core of the coldest water out there in the east central Pacific. So it may not be capturing what could be a Modoki La Nina. So we'll see how it pans out. But this is kind of my guess, and I do use the term guess generally. Now, real quickly, there are some global sea surface temperature anomaly outlooks. This is from a tool, again, available on the interwebs. This is the Community Collaborative Systems Model climate forecast process that from Boulder, Colorado, and many other entities have come together, university systems, to develop a climate model, which quite frankly is better than the American CFS. So I look at this quite a bit, but these are sea surface temperature forecasts for individual seasons, August to October in the upper left, all the way down to January through March of 26. And it shows the La Nina fading. It shows the colder water kind of in the central Pacific, then goes away with the slightly warming off the South American coast, which furthers my belief that it'll be this Modoki La Nina. So something of an untypical La Nina. Now, for the fall and winter seasons, the CCSM4 shows a very distinct warm spell, August to October, starts to cool slightly to perhaps normal over the northern plains, but very warm in the southeastern U.S. up into the Midwest. As we get into winter, we really don't see the cold surges coming down. So this would be the difference in a Modoki La Nina, in that we wouldn't get the typical cold surges in a classic La Nina. So a normal temperature pattern, my analogs are on the cool side of normal, a little cooler than these, but this is a dynamic model that tends to capture the changes better than the analogs do. Precipitation wise, not a whole lot going on there, because this would show that there's not a lot of dynamic systems except through the central plains from the southwestern U.S. into the western Great Lakes. This shows generally an above normal precipitation pattern during the core of the late fall into the beginning of the winter season. Otherwise, the CCM4 model is not really showing a whole lot of bias for significant precipitation. So from these models, a normal winter for what that's worth. Quickly looking over on the other side of the world, it looks like it's going to be a fairly warm winter across the northern hemisphere in China, Russia. Large sections of the northern parts of that continent should be warm. And precipitation-wise, India and along the Indian Ocean regions look to be wet. But again, the model is not picking up much in the way of precipitation bias in those areas. And I did send Jenna. I meant to include it earlier, and I apologize. So if she can share that with you, I did put together kind of a briefing for what the implications are for the harvest seasons in the northern hemisphere and the planting season in the southern hemisphere, Brazil and Argentina, based on the expected precipitation and temperature patterns. So here's August, September, October. Mean precipitation in Argentina and Brazil, which I think are two of the areas that are really kind of heavy in the soybeans, shows relatively normal temperatures in Brazil with above normal precipitation. Argentina, warmer than average and wetter than normal in the north. And this would be, I think, the planting season. Again, as we get into September, October, November, and I think I flipped that, didn't I? Forgive me. That Argentina's warmer and wetter, and Brazil spots of warmth with dry in the north and wet in the south. It's been a long day, folks. A lot of severe weather. October, November, December. Brazil, warm and dry. Argentina, generally normal to some spots of above normal precipitation in the north. So, and then finally getting into the core of their summer, November, December, January, warm and a mixed precipitation bag over Argentina. Brazil warm in spots, but generally dry in the north near the equator and south, and a little wetter in the southeastern coasts. Now, I want to throw this out there. Some of you may have heard of something called Weather 2020 or the LISAC recurring cycle. I don't want to spend too much time on this. This is a fascinating technique that actually parallels the canonical analysis or my analog process. This gentleman has developed a tool by which he goes back and looks at historical data as I do, but he has a different technique for putting it, makes prettier maps, a little more detail. And so based on the Weather 2020 model, most of the region will remain on the mild to warm side of normal into August, into October. Now, again, the scaling is a little misleading because of the colors he chose to use, but on the left side, that's generally above average temperatures for daytime highs and average to above average for nighttime lows. Precipitation-wise, it is for the most part within the normal range, wetter across parts of the Midwest and into the parts of the lower east of the Midwest. Similar to what I was showing earlier, precipitation slightly higher along that Dakotas border region, a little north of where the analogs had it. So essentially showing a normal precipitation pattern in parts of the area, especially where it's slightly browner, and in the greens, a little wetter than normal. The highest above normal precipitation patterns from Kansas, South Missouri, into the parts of Illinois, Indiana. And if you're interested, I can give some more information on this. This is October through December, showing essentially the same kind of a deal with temperatures running generally above normal for highs in the normal range, some perhaps cooler than normal over northwestern North Dakota into parts of the central, but otherwise above normal temperatures for lows. So together we're looking at overall a relatively mild winter. Again, if it turns out to be a Modoki La Nina, that would make better sense without having the frequent cold surges we often get. This is total precipitation. And I apologize because on my screen, they're pretty bright when I'm looking at the preview, but when I'm looking at what is going out online, it seems to wash it out for some reason. But it does show that precipitation generally at or above normal, similar to what the analogs were showing over portions of Minnesota, generally drier in some areas over North Dakota, South Dakota, with kind of an axis of above normal precipitation across northeastern South Dakota down in those areas. So I apologize for that. It looked better on my screen than I'm seeing the what's going out. So recent updated research suggests the evolving changes to the overall climate pattern, in part due to the 2022 South Pacific eruption. The implications are still being realized. A lot of discussion going on in the climate world about what ultimately this will mean for climate forecasting. Precipitation will most likely be higher than normal in many areas due to the atmospheric moisture increases, and the new normal is emerging versus the new normal that's being driven by CO2. And despite the forecast of a cool neutral ENSO, I'm thinking it might be this Modoki La Nina week, increases in atmospheric moisture will probably offset some of the more classic cool ENSO signals. That's why I'm thinking warmer. Now, snowier than normal, precipitation forecasting in the winter is in some ways more difficult than in the summer. Convection, we have a good handle on. Snowstorms, I'll let you make up your own comments about those. There are many indications, at least in some of the modeling and data, that the Modoki La Nina may be in the offing, and La Nina fall and winter seasons tend to be above normal in the precipitation, and the impacts of the increased moisture is unclear. But classic synoptic meteorology suggests wetter than historical infers, but warmer due to infrared feedback, so something we've got to take into consideration. I'll close out with two references that for those of you who really wish to dive into the realm of climate, Dr. Judah Cohen of the Atmospheric and Environmental Research Lab. If you remember, probably 25, 30 years ago, you heard stories about in early snowfalls in Siberia led to cold winters in the northeastern U.S. There was a doctor, Dr. Judah Cohen. He made a big splash in the media with several predictions for heavy snows in the northeastern U.S. Well, like us with El Nino and La Nina, some early successes were like, man, we're on to something. Then he had a series of spectacular failures. Well, like any good scientist, you go back to the drawing board and say, well, what went wrong? Dr. Judah Cohen has refined his process. And if you don't mind digging into the nuts and bolts of synoptic meteorology and climatology, he puts it in pretty plain language to understand what's going on. And he does predictions into the winter season as well. I read him on a regular basis, and we agree more than not. The Lezak recurring cycle, it is a fee-for-service model. I'm kind of testing it out right now to see if it's something viable to use in presentations on a regular basis like this, as well as my little side business when I go out and do talks elsewise. But so far it's promising, but it's like any weather tool. You've got to use a lot of interpretation. And finally, forecast accuracy. A lot of people like to look at the Weather Channel, Microsoft. There's the Weather Service digital forecasts. There's an entire suite of forecast products that come out. These silly little computers most of us walk around with all have a weather app on them. You can find your weather app probably at a website called forecastadvisor.com. They tabulate data of all the different weather apps that are out there and give you a relative accuracy rating. So the Weather Channel, Forca, and Microsoft, which all make general forecast products, overall in 2024 were the most accurate, above the National Weather Service, which was 67% accurate. So, and in my world, anything greater than a flip of the coin, that's a hit. So that's it. I know I zipped through a lot of stuff pretty quickly, which I want to do, but there's a lot of information. If there are any questions, I'll be happy to entertain them. Thank you for letting me be here. It's been fascinating, and I'll take doing corn and grain prices over forecasting the climate.
Thanks, Mark. Appreciate that. I'm sure all of us will have our eyes on the weather the next 2 days, for sure. I'm looking to see if there's any questions in the chat. I'm looking to see if we've got anyone coming off mute. I'm not seeing anyone. Thanks to all who have hung on through the whole morning. We still got a crowd online here, so I appreciate that. We've got a thanks in the chat, so go ahead and speakers review that before you leave. If there's no other questions, we will close out and send everyone along with their day. Again, we did record this, so if you know of someone that should have this information, please share that with them. So the way we've done that in the past is I'll usually email a link from our website to the attendees. And so I do want to again thank our speakers for all of their input. I appreciate the questions and discussions that we did have. I do want you to remember that today's seminar was funded by soybean checkoff dollars. And so happy that you joined us to take advantage of that today. So with that, seeing no further questions, I'm going to close the session. You can always reach out to North Dakota Soybean Council if you have any questions. And I just want to again thank our speakers before I close out here. Thanks, everybody. Have a great day.